Anyone who says they have certainty on where the growth outlook is going, where the tariff picture is going to settle, is probably exaggerating somewhat.
We just don't know yet what the impact will be.
Concern is that you need to see stability in the data. You need to see some level of clarity.
Macro volatility uncertainty will trump the deregulatory positive catalyst.
There's probably less than 3 people in the world that know exactly, what the future looks like.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday as US-China relations sink to a new low.
China has a surplus of $1 trillion. I mean, the numbers are crazy. I don't blame China. I don't blame anybody. I blame the people that were sitting at that desk in that other beautiful Oval Office for allowing it to happen. We'll see what happens with China. We would love to be able to work a deal.
China isn't coming to the table this morning. The nation raising tariffs on U.S. goods to 125% after U.S. tariffs on China rose to a monster 145%. The policy volatility raising questions about America's safe haven status, investors confronting an ugly combination of higher bond yields and a weaker dollar. Evercore's Krishna Guha writing this: there are only 4 other episodes in the last 30 years in which the dollar depreciated more than 1.5%, with the 30-year bond yield up by more than 10 basis points. The last 24 hours, stocks down, yields up, dollar weaker.
We may look back on the past 2 weeks as the most consequential in modern financial history in terms of a reordering of global affairs, or we may be looking at something that is highly technical that we give a very dramatic narrative to. The difficulty here is how much is what we're seeing a decoupling in financial markets between the rest of the world and the U.S., and how much is things like China selling treasuries, like basis trade unwinds, and like people who don't like uncertainty and are simply boycotting this market.
Very difficult to keep up with what's going on. So if you're just waking up this morning, welcome to the program. We've got some new numbers. 125% tariffs on US goods. 145 is the number that the White House clarified on Chinese goods just yesterday.
So if you're looking at this, you're thinking basically this is U.S. and China decoupling from each other. The Chinese Finance Ministry came out and said, given that American goods are no longer marketable in China under the current tariff rates, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures. So it does feel like this is the top of the tariff rate between both countries. But what is the off-ramp, especially when the Commerce Ministry out of China is throwing in some shade and some hot rhetoric and saying basically it's become a joke?
We need some guidance. Will we get it? Later on this morning, later this hour, we should get numbers from both JP Morgan and Wells Fargo. Later on this morning, Morgan Stanley at 7:30. What kind of guidance can the banks offer us this morning?
Very little. It's going to be really a dark cloud. There are some things that we could learn. Number one, how much are they increasing their provisions for loan losses? That will be very key. How much are they torpedoing the chance of some sort of resurrection of a wave of mergers and acquisitions? Have the deals that have been put on pause been altogether canceled in light of some of the uncertainty? And just how much are they benefiting from the trading regime, especially in an area where we do potentially see deregulation? These are all things they maybe can give us guidance on. What you do with that guidance, good luck.
Futures up this morning by 0.6% in the FX market. Some major moves. Euro dollar in the last 2 sessions, a 4 percentage point plus move on euro dollar. If we closed here right now for that currency pair, the biggest 2-day move on euro dollar going back to March 2009. Euro dollar 113.58. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, seeing more volatility ahead. The German finance minister joins us as EU leaders meet in Warsaw, and we'll catch up with Gerard Cassidy of RBC as big bank earnings kick off later this hour. We begin this hour with US-China trade tensions sinking to a new low. Cameron Dawson of NewEdge Wealth writing the following: we continue to think the volatility is here to stay, with the tariff reality creating non-linear risks to growth. Bond market volatility likely keeps equity market volatility heightened. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
It doesn't feel like the best performing week of the year for the S&P 500, does it?
Not at all.
What do you make of this chaos?
Yeah. So we think that there are certainly signs that liquidity is tightening throughout FX, and
fixed income markets, which just means that it keeps the volatility heightened. If this was Icarus flying close to the sun, the wax certainly started to melt on the wings on Tuesday night when we saw the bond market gap out and yields really spike higher. Now it's spreading into FX markets, which just suggests to us that liquidity is leaving this market, and we cannot rule out that these big moves continue.
Can we just sit on that relationship between bonds and foreign exchange? How unusual is it to see moves of 40 basis points plus on a 30-year yield in a week, and to see the dollar down at the same time by something like 3%?
It's extraordinarily unusual, and it calls into the question why. There was a great article in the Bloomberg this morning talking about how people are thinking that maybe there is Chinese selling, even though there's not a lot of hard evidence for it. The thing we ask is that if you think a big whale, a big owner of an asset is selling, does that mean that you try to get ahead of it and sell before they sell, which just creates this self-fulfilling prophecy of higher volatility and the risk that you have these yields continue to back up even higher.
Well, and the reason why people were looking at this in part was also because we had a 10-year and then a 30-year bond auction. A lot of people were saying potentially these would fail. They did the exact opposite. They did really well. There was a record amount of indirect bidders. And then the sell-off continued, which raised questions about whether there were different buyer bases, what's going on. At what point will you see stability enough for you to be a buyer?
Yeah. So eventually when yields get high enough, it draws you in because it allows you to be able to offset some of the price decline. You know, we've been seeing things like in the muni market. The muni market had its worst day in 30 years on Monday. And then it had one of its best days yesterday. So you have all of these flip-flops within the volatility and the price action of markets that we say when we look at munis, we'll step into that because if you can buy and hold, then certainly you can tolerate some of this volatility. But if you're trying to trade treasuries, good luck.
This has been a week of psychology on every front. You've been traveling around the country, getting a real lesson in psychology on all fronts, I'm sure. How bearish are the clients who you meet with at a time where Michael Hartnett of Bank of America is coming out and saying that right now many investors are talking about 4,000 on the S&P and just have this incredible feeling of negativity?
We're starting to see some of the optimism begin to fray. One of the things that's been the most surprising is just how resilient investor optimism has been through all of this volatility. The buy the dip mentality, we still saw really strong inflows on big down days. Maybe some of that is starting to wane. We can measure it by looking at the AAII equity allocations. It began the year at about 69%. It's at 66% today. At the lows in 2022, it got to about 62%. So people are still pretty all in on equities, which just means that they haven't thrown in the towel. And usually we see equity allocations bottom as the market bottoms, which is one consistent thing.
Do clients think that Trump will step in?
I think that given the moves on Wednesday, was it Wednesday? Given the moves on Wednesday, what you've created this environment is that you have a two-sided risk. You have the risk to the downside that this could all cascade further lower, but then you have the risk to the upside that you can have a 9-10% move in markets just because of one person changing their mind.
So when it comes to what do you do in this environment, are long-term treasuries even a hedge anymore?
It's a very, very interesting question. We think that eventually, if you see growth start to weaken, meaning economic surprises turn significantly lower, that treasuries will be a hedge because you have the flight to safety and don't rule out the Fed with quantitative easing. The challenge is you're probably unlikely to get hard data to weaken as much in order to draw people into this market, and also to get the Fed to move, at least in the next month. We think we're in that Wile E. Coyote kind of environment where hard data is still resilient because you have a pull-forward dynamic of people getting ahead of tariffs. You also have the calm before the storm when it comes to inflation, which just means that the Fed doesn't have reason to act, and you don't have the confirmation of that weaker data to get people to be drawn into the fixed income market.
Let's talk about the calm before the storm. Let's talk about the storm. UBS wrote yesterday, the growth hit is still substantial. It's not priced. What do you think about the prospect of retesting the low on the S&P?
We think the prospects are rising, and Chris Verone at Strategas put out a note saying that 85% of the time you do retest the low. And given the fact that we're not likely to have the Fed step in with a policy action, which was something that was very important to creating the V-shaped bottom in both 2018 and 2020, that just raises the odds of a potential retest. You have to step back and realize that this market's still trading at 19.8 times forward earnings. That's a very fulsome valuation given the degree of uncertainty and the degree of risk. You haven't really cut earnings estimates that much. 2026 earnings are still at $302 a share, implying 13% growth next year. We think that those numbers are still far too high, which just means that if you put an average multiple on a lower earnings number, you get to a retest.
So think about the phases of the risk aversion we've seen so far. The first phase was just broad-based, very intuitive risk aversion. Equities down, price again, the greater prospect of lower growth and maybe higher inflation in the future. Second phase seemed to be a dash for cash. Starting to see some disorderly moves, some tension. What phase are we entering now? Where are we at the moment? Have we even exited phase two?
Yeah, the weird phase where we're seeing the move in the dollar and fixed income this morning, and yet equity futures are up on that. So I think that we have to be careful not to read too much into one-day moves and extrapolate them into the future, that we continue to see this volatility in these wide bands. And one of the phrases we keep using is a Goethe quote, which is that few people have the imagination for reality. We have to have the imagination for this odd reality that we're living in.
How much do you think that this is a game changer when it comes to international flows into the United States, especially when it comes from Asia, potentially even from Europe?
It's such an important question, and we keep distilling it to something rather simple. If the last 40 years of the economic world order created an environment that was great for U.S. corporate businesses, allowed for operating margins to continue to hit new highs, for capital to be drawn into the U.S., to have U.S. assets outperform, if you completely flip that on its head, do you still have that same kind of dynamic for U.S. outperformance and U.S. capital flowing into the U.S.? You're completely switching around the world order of the last 40 years.
Cam, I hope you get some rest this weekend. Best of luck. Good to see you. As always, thank you. Cameron Dawson there of NewEdge Wealth. Equity futures on the S&P at the moment, wild few days. Equity futures at the moment up by 0.5%. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. China will raise tariffs on all U.S. goods from 84% to 125% starting tomorrow. The Ministry of Finance said that it will ignore any further increases announced by Washington because the Trump administration move have become, quote, a joke. The announcement came a day after Trump increased levies on Chinese goods to 145%. Tesla has stopped taking orders in China for its Model S and Model X vehicles due to escalating trade tensions. The company's Shanghai factory only makes Model 3 and Model Y cars, while the Model S and X, the ones that it's stopping, are imported from the U.S. and subject to increased tariffs. House Republicans narrowly passed a budget outline paving the way for a tax cut package. It would cut taxes by up to $5.3 trillion over a decade and raise the debt ceiling by $5 trillion in exchange for $4 billion in spending cuts. However, conservative hardliners want to trim $2 trillion in spending, which may require curbing social programs. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny later this hour. Up next on the program, China striking back.
We'll see what happens with China. We would love to be able to work a deal. I have great respect for President Xi, and I think that we'll end up working out something that's very good for both countries.
That deal doesn't look close this morning. Up next, The View from Europe. We'll catch up with the German finance minister. Live from New York City this morning. Good morning. China retaliates this morning, 125% tariffs on U.S. goods. Your equity market, wild week for stocks. On the S&P 500, positive by 0.6%. On the Nasdaq, up by 0.6% on the session so far. The next stop, the banks later this hour, a report from JP Morgan. Turn to the bond market, 2-year, 10-year, 30-year. 30-year yields in the spotlight. A move of more than 40 basis points on the week this morning, 482.53. Lisa mentioned that note from Michael Hartnett at Bank of America. This quote in that note: Musk owned the long end in Q1, but now the long end owns Trump. 482.53 this morning, and that comes even with this move in foreign exchange. Euro-dollar, a two-day move of almost 4%, the biggest two-day move going back to 2009. Euro-dollar this morning, 113.73. Under surveillance this morning, China striking back.
We'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries.
So here's the latest this morning. China retaliating with 125% tariffs on all U.S. goods after the White House clarified levies on Chinese goods rose to 145%. China saying it will ignore further increases coming out of Washington. Joining us from Washington right now is Bloomberg's Tyler Kendall. Tyler, it does not look like China's coming to the table.
Yeah, hey, John, good morning. No, at this moment it doesn't. And President Trump, while he's trying to strike that optimistic tone when it comes to a potential trade deal with China, he does say that he's still waiting on Beijing's call. And now Bloomberg Economics estimates that a 100% tariff on Chinese goods would virtually halt all U.S. imports from Beijing over the medium term, let alone the now 145% levy that we're seeing. We should say that that is a 125% tariff stacked on top of that 20% tariff that went in against Beijing back in February over those alleged concerns when it comes to fentanyl trafficking. Now, of course, all this contributing to the concern in the markets, as you know, with President Trump reiterating yesterday that there is going to be some, quote, transition costs for long-term gain. And Treasury Secretary Scott Bessent really downplaying investors' concerns, calling yesterday's market moves not unusual and vowing that there will be certainty in the next 90 days. But, of course, the issue is that there is so much uncertainty, particularly when it comes to the future of a trade deal with China. And when it comes to the other more than 75 countries that this White House says have reached out to try to strike a deal, NEC Director Kevin Hassett yesterday actually narrowed that number in scope. He said that the White House is approaching about 20 countries that have put forward deals that he characterized as sensible. And John, I actually had the chance to catch up with the NEC director yesterday at the White House, and while officials keep pointing us to those non-tariff barriers that we often hear about, like regulations and taxes, he also told me that military matters, like U.S. defense spending abroad, could make their way into the deals that we end up seeing. And John, as you know, this White House is now really trying to push that this is about economic security, but also national security as well, which is often related to our competition with China.
Tyler, thank you. Tyler Kendall down in Washington. More from Tyler later on this morning. That's the relationship between the United States and the Chinese. Let's talk about the Europeans. Stuck somewhere between a rock and a hard place right now. Bloomberg's Ollie Crook joins us with a special guest. Good morning, Ollie.
That's right, Jonathan. I'm here in Warsaw at the sidelines of the finance ministers meeting where European finance ministers are really trying to devise a response to the Trump administration. I'm very pleased to be joined by a man at the center of that conversation, Joerg Kukies. He is Germany's finance minister. Thank you so much, Minister, for speaking to us today. We heard from Ursula von der Leyen today. We still know that the Europeans want a negotiated outcome. She's calling for a completely balanced deal between the EU and the United States. What does a completely balanced deal look like?
Well, I think the European Commission made it very clear that the best solution is to reduce all tariffs to zero. And I think that is what complete balance means. If we go 0-0, then we no longer have to debate around asymmetries of who's levying the higher tariffs.
And as you know, the Trump administration is really focused on this concept of non-tariff barriers, very abstract concept, could target VAT, food standard regulations, tech regulation, those sorts of things. Is it appropriate for that to be on the table in these discussions? Is it appropriate for D.C. to legislate Europe from there?
Well, certainly the allegation that the European VAT system in any way, shape or form distorts trade is wrong. That we will categorically push back on, because everyone pays the same VAT. That's the difference between a VAT and a tariff. So European companies pay VAT, US company pays a VAT, just like everyone in the United States pays a sales tax. So that is certainly something that we do not accept. What I do think offers room for negotiation, for example, the automotive industry has proposed standardization and homologization, i.e. that if you have license to operate a car in the United States, whether it's built by an American company or a European company or a Japanese company, it also has the right to operate in the European Union and vice versa. So if we build a car in Europe, it has a license there, it can drive in the United States, and that would increase the economies of scale for both of our automotive industries and be mutually beneficial. So those things are absolutely, from our view, possible and doable and should be debated.
And on the question of possible retaliation, it seems that the markets are pushing Trump towards a sort of softer stance. That, of course, could change. What do you see as the greatest points of leverage that Europeans have in order to retaliate against the United States?
Well, the Europeans have a market of 450 consumers of goods and services. I think we have to balance the debate because while, yes, the European Union has a trade surplus on goods, the United States has a trade surplus on services. And net, the overshoot of one over the other is only about 3% of aggregate trade. So in that sense, we have to discuss both the goods side and the services side together.
And so specifically, what measures are you looking at in terms of targeting services?
Well, I mean, the Commission proposal for the steel and aluminum sector, I think, was very well balanced and took into account the products where we can substitute easily, and if there are tariffs by products from other regions of the world. But, you know, the Commission has suspended those for now to leave room for negotiations. So for now, we have to worry less about retaliation and more about what a good trade deal could look like.
And within the markets, we've seen a flight from U.S. haven assets, from U.S. Treasuries. You sort of preside over the other great haven, the Bund. Do you think that the Bund could replace the U.S. Treasury or to a certain measure?
Well, I think the European Union now has a chance, and the Eurozone has a chance, to give stronger weight to the euro in global trade. For that, we would need an initiative from Europe to reach out to other regions of the world to speed up the conclusion of free trade agreements. For example, Mercosur is on the table, it's already signed. There's far-reaching negotiations already with Indonesia, with India, with Malaysia, with many regions of the world where there are negotiations. Those should be accelerated. We should start by lowering tariffs and then get into proper free trade agreements, and that would strengthen the role of the euro.
And on that point, we saw Pedro Sanchez speaking today in Beijing alongside Xi Jinping. Does all of this activity from the United States push Europe closer to China?
No, I don't think that has, I mean, we've been discussing the relationship and the strategy with respect to China for a long time. The fact is, the United States has just replaced China as Germany's big trade partner. Germany is now exporting more goods and services to the country we're in, namely Poland, than to China. So in that sense, the diversification of trade has already been going on for a while, and it's likely to continue because we are seeing that due to the Chinese strategy of China 2025, dual circulation, etc., it's getting harder and harder for German companies to follow the classic model of building in Germany and exporting to China.
And a final question on that. The euro opened yesterday at 109. We broke through 114 today. There's been a huge surging in the euro. That is going to make it also very difficult to prevent goods from China to come into the European market. What are you doing to prevent that? Do you need to erect more trade barriers against China?
Well, first of all, on the euro, of course, we're concerned about volatility in markets. So far, the markets are behaving in an orderly fashion. We've first seen a strengthening of the dollar relative to the euro over the past months, and now the euro is recovering and even going into positive territory relative to, for example, the time of the U.S. election. So in that sense, we're watching markets carefully, but we don't see anything disorderly or the markets are functioning very well. On the discussion on China, of course, you can take the example of the automotive sector, the battery electric vehicles, where the European Union has made decisions and is now negotiating with China. And one of the elements on the table, of course, is level playing field. And Europe rightly insists on a level playing field, and that has to be satisfied, and we cannot accept unlevel playing fields.
Well, Joerg Kukies, thank you so much. That was the finance minister of Germany here speaking on the sidelines of the finance ministers meeting here in Warsaw. John, I'll send it back to you.
Ollie, great work. Thank you, buddy. As always, Ollie Crook there with the German finance minister, using our favourite line, when in doubt, we're watching markets carefully. Up next on the programme, Gerard Cassidy of RBC looking ahead to bank earnings. BlackRock just coming out, flows disappointing. Larry Fink comparing this period to periods like the financial crisis, COVID, and surging inflation back in 2022. From New York City, this is Bloomberg. This week is not over yet. I know it doesn't feel like it, but on the week so far, we're higher by 3.8% on the S&P 500 through Thursday's close, on course for the biggest weekly gain of 2025. Certainly does not feel like it. Futures up again this morning by 0.9%. On the Nasdaq 100 up by 1 percentage point. 3 hours away from that opening bell. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. I'm starting with that outperformance in tech because we are seeing Google shares in the pre-market up 1.4%. It does almost feel like a project in futility to try to assign the exact reason that Alphabet is up, but I will point out the Mag 7 falling 5% yesterday, so there could just be some element of rebound when this thing starts to trade like a penny stock. But I would also point out that the information reporting this morning that Google is laying off hundreds of employees in its Android and Pixel units. Big changes maybe to come for big tech. Dan Ives writing that the tariffs rip out the heart and lungs of the supply chain for these companies, and AI and cloud spending may drop 10 to 15%. We're also seeing on the move this morning, BlackRock reporting its earnings. It actually was lower. It's now moved to unchanged this morning, missing on flows. We did also see them miss on profit, too. And, of course, the quarter doesn't even capture the onset of tariffs. We heard from Larry Fink saying that uncertainty and anxiety is gripping client conversations, lightening the period to the great financial crisis, COVID, and the inflation pickup of 2022. Finally, just want to show you a price check on JP Morgan just to see where we stand ahead of the earnings. Those shares are moving higher, 1.3%. So in about 30 minutes time, we'll get JP Morgan alongside Wells Fargo. And then 30 minutes after that, Morgan Stanley. John.
Danny, looking forward to it. Thank you. Danny Berger there. On some of the things to watch this morning, on our radar this morning, China raising tariffs on all U.S. goods to 125% and saying it plans to ignore any further tariff hikes announced by Trump. The move coming after the White House clarified that levies on Chinese goods, Lisa, are now at 145%.
That's higher than on Liberation Day, and the fact that it took them a while to even come up with what the calculation was gives you a sense of just how much uncertainty there is. Right now, there is a shift in the dynamic. It seems very difficult to see China calling that phone that Trump is waiting by to get that call from Xi Jinping. Now the question is, how feasible is some sort of decoupling, and whether China is taking other tactics like selling treasuries?
And they're throwing gasoline on the fire when it comes to the rhetoric, let alone you think Xi Jinping's going to pick up the phone. They said it's become a joke when it comes to these tariff rates, which is why they said even if the United States hits back, we're probably going to leave it here. But Trump has been very gracious about Xi Jinping himself and saying if he does call, I am going to welcome that call. The issue is, what is the off-ramp right now for both Washington and Beijing? There doesn't seem to be one.
They're still waiting for the European move as well. We had the German perspective about 5 minutes ago. This is the Spanish perspective. Spain's Prime Minister repeating calls for the EU to deepen ties with China, following a meeting with Chinese President Xi Jinping. This coming after Treasury Secretary Scott Bessent warned the EU against pivoting towards China and away from the United States.
Scott Bessent actually has some sharp words saying that would be cutting your own throat. And what the Treasury Secretary has talked about is actually doing deals with all the trading partners and then collectively approach China and try to go after some of the things China does, like subsidies, like dumping on foreign markets, like pushing down their currency, making it much easier to trade, things that they're doing that, frankly, no other trading partners are doing, which is why Donald Trump has a huge problem when it comes to Xi Jinping. But when it comes to Spain, this is what makes the European Union so difficult. Pedro Sanchez, this is his third visit, I believe, in 2 years to Beijing. And on this visit, he's saying that the U.S. levies are unjustified, unjust, and harmful for everyone. I wonder what his conversations are looking like in Beijing about their unjustifiable trade.
I'd love to be on a fly on the wall, just to see if that is being pushed by the Spanish at all. You're seeing a rapid series of diplomatic visits from a range of countries. Mexico's having its say. A Mexican trade official saying the country wants a greater proportion of each auto built there to qualify for U.S. origin status. The move would temper the impact of Trump's tariffs on one of Mexico's most important exports.
So they're looking for exemptions. They're looking for carve-outs. They're trying to figure out how to get their iron in the fire here, which just highlights how difficult these negotiations are going to be. And a country by country basis. It is complicated by the fact that right now the administration, I believe, is looking at suing Mexico for not providing and stealing water from Texas, according to the rhetoric coming out of there. So those tensions aren't over. What this highlights to me is that in these 90 days, there is a lot of work to do, and it's hard to see how it all can get done smoothly, easily, with concrete deals.
Let's see how smooth the next 15 minutes are. Equity futures positive by 0.9% in just a moment. Numbers from JP Morgan and Wells Fargo as we await first quarter results from the big banks on Wall Street. Joining us now, Gerard Cassidy of RBC. Gerard, welcome to the program, sir. What an unusual reporting season for the banks on Wall Street. What are you expecting to hear in a few moments' time?
John, that was an understatement about how unusual this reporting season will be, because it's a tale of two cities. The actual quarterly numbers, just very briefly looked at Bank of New York. They just hit the tape. Looks like they beat expectations on the bottom line. But you bring up a good point, because what we're likely to see is the first quarter numbers, especially for January and February, were actually pretty good for the banking industry. It was really March, and then, of course, here in April has been very disruptive. So what we're expecting is that we're going to see decent, good numbers in the first quarter for most of the banking services, particularly trading for the big investment banks. Investment banking revenues are expected to be down year over year. But more importantly, it's what they're going to talk about in the future, John. That's, what do we expect for the rest of the year? And that's going to be very interesting.
Yeah, Bank of New York, since you just mentioned them, they did see a real boon from what we saw with net interest income because of their reinvestment in higher income-producing instruments. This doesn't seem like a main story for the rest of the banks. The main story is going to be about loan loss provisions. It's going to be around mergers and acquisitions and how much that continues. And it's going to be around just how much they are expecting and preparing for a recession. Gerard, are we expecting to hear anything concretely that gives us a sense of just how much some of these banks are preparing for that?
It's going to be interesting, because the net interest income number that you just referred to for Bank of New York, that is very favorable for all the banks, particularly the regional banks, since the majority of their revenue, of course, comes from the net interest income line, which is what they generate from their earning asset yields less their funding costs. And that's the key. Remember, the so-called back book, those are the loans and the securities purchased 3, 4, 5 years ago. They're being reinvested at higher yields, and their funding costs are coming down. So that bodes well. But you touched on something important, which is the loan loss provision or credit. Under the current accounting standards, as the economy or the expectation that the economy is going to deteriorate, you've got to build up your reserves. And we expect that to be the case in this quarter for all the banks. But there's no credit deterioration that they're seeing. It's an accounting procedure that they have to start building up those reserves. So those will be two key numbers for all the banks, even the large money center banks.
Let's bring Sonali Basak into the conversation as well. Sonali, welcome to the programme. As always, a big moment for the big banks, but it feels bigger this time. We heard from Jamie Dimon already so far this week, and he appeared to play a key role in that 90-day pause that we eventually heard from President Trump.
Yeah, when there's crisis, of course, Jamie Dimon is a front and center. And you remember, when things get tough, JP Morgan has benefited in large ways. I'm reading our own Top Live blog now in preparation for these earnings, just, that drumbeat. And you remember during COVID and during the banking crisis, JP Morgan was able to make out very well, take on teams, by a bank. And so in this instance, what's interesting to me is the estimates right now for trading revenue alone, speaking to Gerard's point about how well they're supposed to do, is supposed to be almost $2 billion more than the prior quarter. That's how much more they're supposed to gain. Now, even in the last 4 quarters, John, you've seen their average loans rise at a smaller pace. So in addition to loan losses, I'm watching how much they're actually lending in this environment. We also get University of Michigan sentiment later today. Are consumers willing to take on loans? We know businesses more recently have not been able to.
Sonali Basak on the latest. Sonali, we'll cross over to you in just a moment when those numbers drop in the next few minutes. I want to come back to you, Gerard, and just get your thoughts on Jamie Dimon and the CEOs on Wall Street more broadly. Are you expecting an unvarnished view of what they think is going on right now, or do you expect them to take a more diplomatic approach, worried about how that might turn out with the administration in weeks and months to come?
I think the way Jamie Dimon presents his thinking and what's going on is very realistic and straightforward. You could call it unvarnished, but I think he's very good at telling, everyone the way it is, the way and what his expectations are. So he's not going to sugarcoat or candy coat it, nor will I don't think any of the other CEOs. That they'll be very practical and straightforward about what they're seeing, what their business customers are telling them about their borrowing needs, and what the opportunity is for loan growth. That's going to be another big topic, is we expect the loan growth numbers to be much slower than what we all thought in January.
It's the real-time data we need right now. Gerard Cassidy of RBC, stay closer. In the pre-market, JP Morgan higher by something like 1%, 2%. Lisa, we can't depend on economic data at the moment. People say it's dated. This is a real-time look at the US economy coming from the bank CEOs over the next hour that I think is so important in a moment like this.
How much are they preparing for some sort of recession by building reserves, even without any visible deterioration in credit loan losses? How much are they discounting the resurrection of all of those mergers and acquisitions that we were supposed to get? Are those off the table now? And just how much are they preparing for bad times ahead, especially given that the source of volatility is in the safe asset, the Treasury market?
Earnings season kicking off on Wall Street. Equity futures up by 0.8%. With an update on stories elsewhere, with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Bank of New York Mellon saw a 6% increase in the first quarter revenue and a 21% profit jump. But the results don't factor in recent market turmoil caused by President Trump's tariff rollout. The bank warned of an uncertain outlook ahead as it undergoes a continued cost-cutting overhaul. Elsewhere, Mexico is vying to protect its auto shipments to the U.S. in the wake of President Trump's 25% tariffs on cars. A trade official says that the country is looking for ways to move parts of the production process to the U.S. to increase the deduction. He said Mexico's goal is to have one of the lowest tariff rates of any country in the market. In Europe, leaders are reportedly planning a trip to Beijing for a summit with President Xi in late July. The South China Morning Post says that the trip indicates a serious effort from the EU to re-engage with Beijing. The U.S. and China are also starting talks to end the EU's duties on EVs from China amid tensions with the U.S. over tariffs. And that's your brief, John.
Hey, Danny, thank you. Danny Berger there with the latest. Up next on the programme, earnings season kicks off on Wall Street.
Investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
In just a moment on this programme, numbers from JP Morgan, reaction from Gerard Cassidy of RBC, and Sonali Basak will break it down. From New York, this is Bloomberg. Just seconds away from numbers from JP Morgan and Wells Fargo. Can the earnings from the big banks improve the mood on Wall Street? Equity futures at the moment positive by 0.7% on the S&P. Under surveillance this morning, earnings season kicks off on Wall Street.
The whole capital markets renaissance is just not quite happening. But trading, as you can imagine, given all this volatility, trading could be lights out for this quarter. The reaction of banks really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, that's what the market sort of needs to hear.
Numbers from Wells Fargo just crossing. To break it down, here's Sonali Basak. Hey, Sonali.
John, we're taking a look at Wells Fargo coming through. And of course, in addition to looking at the loan loss provisions, we are looking to see how their return on equity is. Their net interest income is holding in at $11.5 billion. Now, that is less than expected. That sets the tone, doesn't it, for the rest of the bank earnings season, particularly for the many, many regionals that are going to look at potential lending income under pressure. You are not seeing shares reacting, but remember, Wells Fargo did fall more than, for example, JP Morgan has this year. JP Morgan only seeing a decline of roughly 5% on the year. We are, however, also seeing JP Morgan numbers coming in. We'll also give you the guidance. We are watching guidance closely from these banks. Wells Fargo still sees full year net interest income growth to 1% to 3% higher. So that is a very promising sign coming from a bank where people have been somewhat concerned here about the trajectory of consumer lending.
So, Sonali, it's a miss on net interest income, but as you say, the guidance is still OK. It's difficult to guide in this moment. I would say it's difficult for analysts to even come up with an estimate for the first quarter, considering the warnings we had from elsewhere. As you say, Sonali, JP Morgan numbers out just as well. What do you see?
A few things. Provision for credit losses at $3.3 billion. We'll dig into that in just a moment here because that is a smidge higher than what we had been seeing analysts estimate. However, you are seeing the stock really shrug this off. You are seeing fixed income sales and trading revenue come in just a smidge below estimates here. But remember, this is where the trading estimates were estimated to be very high. You're seeing a net reserve build of almost $1 billion, around $973 million. Equities trading did come in above estimates, John. I think this is where things get really interesting here because remember, hedge funds did come into this year with near record high leverage, but a bank like JP Morgan, I would say for Morgan Stanley as well, captures the retail traders as well. JP Morgan in the last quarter coming out with even new ETFs to capture the volatility and maybe even a potential decline. So you could see JP Morgan in a scenario where they win if you do, they win if you don't. They can win in a lot of scenarios here. And certainly the stock up 2.5% pre-market. That's erasing almost half the losses for the year so far.
Sonali, can I just come back to you with another number and get your thoughts on this? The net reserve build of $973 million. How important is that this morning?
You know, when I'm sitting here, you could have expected it to be worse. You can expect that they would be building this, right? You saw Jamie Dimon's recession calls be more loud than normal. For him to come out on a television interview days before earnings, how rare is that, John? And you would expect more reserve build to be cautious. But that's what investors would want to see right now. Caution from the banks in the face of this uncertainty.
Well, this economy has bigger concerns than just bank earnings in the first quarter, that's for sure. Sonali, stay close. Let's go through these numbers. So the first quarter for Wells Fargo, net interest income coming in just below expectations. As Sonali pointed out, they still see growth for net interest income for the year ahead. That's positive, given the moment we're in at the moment. If you go to JP Morgan, this is what we've got for both fixed sales and trading revenue versus, say, equity. So equity sales and trading revenue coming in at $3.81 billion. The estimate was 3.18. So that's a big upside surprise. A little downside surprise on fixed sales and trading revenue. Lisa, we often talk about volatility, the good kind and a bad kind. What did we get in the first quarter?
It seems like the volatility in stock trading was the good kind. The volatility in bond trading was the bad kind. And I guess if you talk about the whipsaws that we're seeing, this still is backward looking. So we shall see. Going forward, I think the most interesting aspects are some of the commentary that we're getting from Jamie Dimon, JP Morgan, when it comes to building reserves. It isn't as big as I would have expected, to be honest. You asked Sonali about the almost $1 billion of loan loss reserves. The commentary, though, suggests a greater degree of caution, with Jamie Dimon saying it's prudent to maintain excess capital and ample liquidity, echoing what he said in the letter, and saying that that reserve build was largely driven by changes in the macro outlook, not necessarily by what they're seeing in terms of deterioration on the underlying loans.
The stock is up this morning. JP Morgan higher by 2.6%. Gerard Cassidy of RBC is back with us. Gerard, you've had a few minutes to go over them. What's your reaction?
John, the numbers are good in both cases, Wells Fargo and JP Morgan. What was very encouraging was Wells Fargo did not lower their net interest income guidance for the full year. The 1% to 3% growth that you guys just reported is what they said in the fourth quarter results. Also, what's interesting is the provision for loan losses at Wells Fargo was not that high relative to the prior quarter. It was below our expectations. Now, on the other hand, as you just pointed out, John, the provision from JP Morgan, over $3 billion, that was higher than expected. But what the numbers are showing us is that as these banks build up reserves, they're still beating bottom line numbers. And so that goes to show us the strength of these companies' revenues and their balance sheets. And as Jamie Dimon pointed out in the commentary, this is reserve building. It's not because there's credit deterioration today, as we were chatting a moment ago. This is for the accounting for reserves for potential future losses. And when the economy is weaker or expected to be weaker than expected earlier in the year, this is what they need to do.
Gerard, we're looking at a yield curve that's steepest going back to 2022. Yes, it's for all the wrong reasons and it's spooking the markets. But is this a positive thing for the banks that encourages your view, at least on their net interest income?
Very good point. When you think back, it's 20 years that we've seen the Fed funds rate above 3% with a positive slope to the curve. So even if the Fed cuts 2 or 3 times this year, if the 10-year stays over 4%, that type of interest rate environment with the positive slope is very positive for net interest income for all the banks.
How often have you seen this, Gerard, where the rhetoric is incredibly negative, but the actual numbers are not, both with respect to the credit build, the loan loss build, which is, yes, almost $1 billion for JP Morgan, but it could have been worse with Wells Fargo coming in below. How much does this resonate with another period versus really unique, where there really is a black box ahead of us?
Yeah. We're in uncharted territory because the relatively new accounting came in on January of 2020. Now, granted, we had the pandemic and the banks had to rush to build reserves only to reverse them out in 21 and 2022 since the economy snapped back so quickly due to the government stimulus and the Federal Reserve actions during the pandemic. So this is the first real test of the new accounting, building up reserves. The idea was to get out and ahead of any credit issues. It's more pro-cyclical. The banks have been very critical of this reserve building methodology because it may force banks to pull back on lending. But right now, this is the first time we're really going through it. And as so far, the banks can handle the buildup in reserves due to the strength of the revenues and the interest rate environment they're working in.
Hey, Gerard, hang tight. Just took another leg higher in the stock. JP Morgan up by 3.7%. Check out this headline. Shonali Basak has more. Hey, Shonali.
John, some things that I'm taking a look at here, of course, is exactly how much people are still borrowing at JP Morgan. You are seeing the consumer in good enough shape that the debit and credit card sales volume are actually up 7% year over year. And so things look pretty good in the face of what has been a very challenging environment. I would also say in the face of the volatility we've seen, and remember, this was the first quarter, they do still see full year net interest income about $94.5 billion. That's higher. That's actually $500 million higher than the previous estimate. So they're still expecting to make money on loans, and you are seeing it in the credit card books at JP Morgan. Last thing I'll say, I took a look inside their supplement at their value at risk, because in these markets, you take a look at how much these trading desks are getting stretched. Certainly it is higher, and it is meaningfully higher in the equities business and in the commodities business, partially as you'd expect, not yet in fixed income. My question for Jamie Dimon is how much risk is this bank willing to take on?
Shonali, thank you. Just a final word, Gerard. That was the headline I was looking for. Full year net interest income about $94.5 billion. They had seen about 94. What do you make of a headline like that in a moment like this?
John, that's actually positive for JP Morgan, because you might remember when they've talked about their net interest income numbers during a period of falling short-term interest rates, that kind of lowers their net interest income because generally their duration is on the shorter side compared to some of their other peers. And so for them to come out and give that kind of guidance with the expectation that the short end of the curve is going to come down, again, is encouraging and positive. So when you wrap it all together, the numbers are good as we expected. Nobody was expecting bad numbers on the first quarter, but the outlooks aren't as negative or threatening as maybe some people were expecting.
Gerard, appreciate it. You're going to stick around, I know. We'll catch up with you when Morgan Stanley comes out. Gerard Cassidy there of RBC. Elisa nailed it. The difference between the rhetoric and the actual numbers, that is a positive guide from JP Morgan.
Talking about net interest income, this goes to the upside of a positive yield curve. But all around, as much as they are preparing for possible negativity, there clearly is an eye toward not losing market share and having a very stable position heading into the next leg of turmoil. It is a different time than back in 2008, despite all the comparisons.
Stock is up by 3.7%. Up next on the program, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, the U.S. Energy Secretary, Chris Wright, Gerard Cassidy of RBC will be back with us for Morgan Stanley, and Greg Peters of PGIM, Fixed Income. From New York, the second hour of Bloomberg Surveillance. Up next.
The U.S. is exceptional. Still the most dynamic economy, still the biggest financial market.
The outlook has been very, very bearish on U.S. equities.
Growth is still going to be at or close to flat for this year.
Whatever your economic assumptions were they've got to be lower today.
We are far from out of the woods here. There is a slowdown coming in the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Believe it or not, heading towards the biggest weekly gain of the year so far in the S&P 500. What a wild week it's been. Equity futures this morning positive again by 0.6% on the S&P. On the Nasdaq 100 higher by 0.7%, even with retaliation from China. It is so difficult to internalize these numbers now. China putting 125% tariffs on the US after the US put levies on China to 145. We need to focus on the banks this morning. This from JP Morgan. JP Morgan coming out with new guidance. Lisa, I think this is absolutely phenomenal. For a moment like this to come out and say, you know what, we'll raise our guide. 94.5 on net interest income. They had seen about 94.
This is a time where the rhetoric is this is a very turbulent economy, from deregulation, trade wars, let's raise our excess capital. This could be a real game changer. And by the way, our profitability is going up. Our net interest income, as you said, $94.5 billion versus $94 billion. It goes to this ultimate question. We are in a moment of catastrophic language and rhetoric and very hot tempers and very big threats and historic moves potentially. But at the end of the day, companies are doing pretty well, and banks are in a good position to absorb this and build capital. And this is the dissonance that a lot of investors are striking against.
That stock is up by 3.3% in the pre-market. Let's get to some of that language from Jamie Dimon of JP Morgan. Annmarie, he says it's prudent to maintain excess capital and ample liquidity in a moment like this.
So he doesn't say Trump by name in this statement, but he's talking about Trump in this statement. The economy is facing considerable turbulence, including geopolitics, with the potential positives, though, of tax reform, deregulation, there's negatives of tariffs, trade wars, ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. A long list of worries, Jonathan, from all of these banks, especially Jamie Dimon, because of what's coming out of Washington, D.C.
Let's talk about a few of the words that came out of Washington yesterday. The President of the United States, there will be a transition cost and transition problems. Who's going to pay that price in the quarters to come?
It's a great question. This is the ultimate question. Is it going to be consumers? Which consumers? At the high end, maybe there is some capacity, but we have seen with Walmart, they're going to try to take share by absorbing those costs in their margins. This is the ultimate question. What does an adjustment period look like? What is on the other end? Because we still don't have a sense of what the goal is. Is it a full decoupling, or is it something that is a new rules of the game that is still at least playing the game?
Equity's pretty volatile this morning, as you might expect. Once again, equity futures this morning positive by 0.6%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as China imposes 125% tariffs on US goods. We'll speak to the Energy Secretary, Chris Wright, on President Trump's push to drill, baby drill, and Greg Peters of PGIM Fixed Income as Treasuries start trading like risk assets. Bank earnings kicking off in the last hour. Bloomberg's Sonali Bassett can break it down. Hey, Sonali.
Good morning, John. You are seeing JP Morgan shares higher after they said that they expect more net interest income this year than earlier expected. They raised their projection for 2025 by about $500 million. And you also see provisions for loan losses coming in higher, though investors clearly shaking that off because JP Morgan tends to be conservative. Of course, Jamie Dimon all week has been warning of increased uncertainty in the macroeconomic environment. You also see Wells Fargo higher as well because they kept their net interest income guide stable. As Lisa has been mentioning all morning, you do still see a steeper yield curve. And from JP Morgan's numbers, you also see an inclination from customers to borrow, particularly those debit and credit card loans still up by 7% in the first quarter, even in the face of this uncertainty.
Sonali Bassett on the latest. More from Sonali later this morning, 7:30 Eastern Time. You'll hear from Morgan Stanley. This line from Jamie Dimon: we hope for the best, but prepare the firm for a wide range of possibilities and scenarios. That range of scenarios, incredibly wide. This is what Sarah Hunt of Alpine Saxon Woods has to say. The damage has been done, both to markets and to sentiment. Goes on to say, what we do know is that the uncertainty is likely to continue. Sarah joins us now for more. Sarah, good morning.
Good morning.
How much weight can you put on the guidance from the banks this morning?
Well, I think it's interesting that they're giving guidance at all, because I expected a lot more of a, not necessarily polling guidance, but a larger uncertainty. We were going to bracket things. So I think that there is a call to strength there that says, you know what, we see what's going on. We see what's going on in the fixed income markets, and we see that this is actually going to be a decent year for us. And I think for the bigger banks, that's an easier thing to say than it is for some of the smaller banks.
Think how positive people were coming into 2025. Sentiment sky high, loan growth will improve, capital markets activity is going to be fantastic. Lisa was asking this question in the last 30 minutes or so. The capital markets activity now for the financials, delayed or derailed? Which one is it?
I'm going to say delayed. I don't think it's necessarily derailed. I think that ultimately, you know, what was interesting about the comments that you brought up earlier, Annmarie, was that in that long list were some of the things that are supposed to be positive, which is the deregulation and which is some of the mergers and acquisitions and stuff that we were talking about going into this. But the fact that the tariffs came so soon and the tariffs came so hot relative to what the expectations were, I think has got everybody going, losing sight of the fact that there may be other things. And I'm not sure any of us know exactly what that's going to be.
Is the market reacting to the hot rhetoric, or is the market reacting to market structure issues that are amplifying moves that are then causing people to, for lack of a better word, freak out?
So this is another problem where the answer is yes, because it's all the things, right? It's both they're reacting to the moves, and there have been some ongoing discussions about what's going on underneath the markets and whether there's anything going on within the structure of the Treasury basis trade, the FX markets. So I think that there's a combination of things where you get the first reaction on fundamentals, and then the second reaction comes from things that we're not necessarily able to see.
Where are we in that? I mean, is there a sense that there's something that just blew up, or there's something that's in the process of blowing up, and we're watching it and then creating a narrative around American exceptionalism around it, and then adding some talk about that, and everyone's running to the edges and just hiding? I mean, I'm trying to figure out the anatomy of what is going on after a really tumultuous couple of weeks.
I think that you are not the only one. I think all of us are trying to figure out what's been going on underneath the surface and or the size of some of these moves, how problematic that is, because so many firms have levered up more and more as we've had less volatility. And then you get volatility that is off the charts. And you have to think that there are some reactions to that. And some of those are going to be people making a lot of money, and some of them are going to be the opposite. And I don't think we have an understanding right now of which is the bigger piece of that, as money also moves out of the U.S. and goes to other places, which are smaller than the U.S., so therefore the effects are magnified. So I think that there are a lot of different parts of that equation, and I'm not sure that we're able to simultaneously solve it right now.
The Treasury Secretary said yesterday they're going to go through the queue when it comes to these deals they're making with other countries, and then there's going to be a period of, quote, great certainty after these 90 days. Is that what you expect, 90 days, and you get some certainty in the market?
I would love to see great certainty in 90 days. I'm not sure that you're going to get great certainty, because I think that as we go through all of these things, there's going to be continuous changes. So I think that if you take some of the uncertainty off the table, which we haven't yet at all, and I think that there was some expectation that once the announcements were made, that was going to be a catalyst in and of itself from an uncertainty standpoint, and all it's done is ratchet that up. So I think that there is going to be some, as you start to get deals through the pipeline and people start to understand what they are, I think that will help calm things down. But right now we're still in that phase where that hasn't happened yet, and I think that max uncertainty that we all keep hoping to get behind just continues on a daily basis.
The forward multiple on the S&P doesn't scream recession right now. Cameron Dawson made that point in the last hour. From your perspective, given the price move we've already seen, do you think we have the capacity to absorb bad news now, going into the next several months where we might see some pretty big downside surprises on data?
Well, I think that we came into this year with the market at an even elevated multiple than it was right now. So is it back to a place where you can feel very comfortable with it? No, which is why I think that you've got risk to the upside and risk to the downside, because you get really good news and this market wants to take off. You get really bad news and we can say, you know, the multiple's still expensive and it can still come down a little bit. I think that what we're looking for is a very choppy year, unfortunately, and some hope that as you get through some of these issues in terms of understanding what's going to happen, that people can start making decisions and that delayed economic activity doesn't accelerate too much.
So in the meantime, we just want somewhere to hide. Some people do anyway. Some people more aggressive than that. But if you want a tin hat and a rock to hide under right now, it's not the Treasury market. What is it?
It's not the Treasury market. It's some of the areas that have done fairly well in general recessions, those things like consumer staples, they got really, really cheap at the end of last year, and everybody was looking for more exciting things and more growth. And then you look at those multiples and you go, you know what, that's not so scary. Some of the defense stocks have gotten killed also. And so I think that there's some opportunity there. There are some places, even something like Walmart, look at the big banks. There are places where they can absorb it. I think the harder thing is going to be for smaller and mid-cap stocks because the uncertainty is very high right now. And I think for them, it's much more difficult.
I want to sit on one point that you said and make this full circle. The big banks, coming into this year, a lot of people were really excited about them because of the growth in the economy that they were expecting, as well as deregulation wave. That's something that we heard from Jamie Dimon, that the deregulation is going to be a real positive. We also are seeing that steeper yield curve that could also benefit these banks. In some ways, are the banks a haven in good times and bad, given how much they've built capital and what a different position they're in now than pre-pandemic?
I think that it's a much different situation for them now. But I also think if you look back when all the technology stocks are outperforming, the banks are underperforming. So in good times, they tend to lag a little bit. And in bad times, I think people go, oh my goodness, there's a great business model. And we're all looking at cash flows. We're all looking at balance sheets again. All of those things become of utmost importance when you have this much volatility.
Can we finish on tech? What becomes of Apple if we don't get an exemption for that name? What happens to some of these companies?
I don't necessarily want to speculate on what happens to Apple if it doesn't get an exemption. I think that...
Is it that bad that you couldn't possibly even speculate?
Well, I mean, you can speculate and you can say, well, if 90% of their phones are coming from here, then we lose X amount. I think the problem is it is such an, I mean, this goes back to those discussions in 2018 and 2019 that the tech stocks are actually staples of themselves, because are you going to live without an iPhone? And how many people are going to say, okay, now I'll just go back to the method of financing it that the phone companies used to do, and I won't buy it outright, so that $2,000 doesn't become as scary as $1,200. They're expensive things to start with. But I think that the ingrainedness of that technology into our lives is difficult to separate. So I don't know that for that reason it's as bad as it would be, because it's not a lot of speculative buyers of iPhones.
Sarah Hunt, appreciate it. Of Alpine Saxon Woods. We did see some speculative buying of iPhones earlier this week, didn't we? Weren't they flooding the stores?
Yeah, well, and honestly, I think about that. My kids buy phones. It feels like speculative purchases. But also, India, the idea that they loaded up iPhones from India, put them in a plane, forget gold. iPhones are the new gold, and ship them over here gives you a sense of how people are preparing.
People have been flooding these Apple stores, stockpiling, not just iPhones, AirPods, iPads, everything. Get ahead of birthdays, holidays, because the price might be going up.
Buying iPhones off the back of a truck in a few months' time.
100%.
Bring it back to the BlackBerry.
iPhone.
I just want a BlackBerry.
These are first world problems. Equity futures on the S&P 500 up by 0.75%. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, let's just recap some of those bank earnings. JP Morgan shares in the pre-market up nearly 3%. Their stock traders taking in a record haul in the first quarter and raising its guidance on net interest income, but it did add more than 3 times of what was expected for its lost reserves. CEO Jamie Dimon saying it would be, quote, prudent to maintain excess capital and ample liquidity, noting that economic turbulence was there amid trade wars. Now for Wells Fargo, it did miss on net interest income. Shares are higher, though, 2.33%. Loan demand did remain soft. CEO Charlie Scharf said that the bank is preparing for a slower economic environment amid continued uncertainty and volatility, and that a timely resolution to the White House's trade action would be good for business, consumers, and the market. Elsewhere, Defense Secretary Pete Hegseth plans to cut $5 billion in contracts as part of his partnership with Elon Musk's Doge efforts. The cut will target services, including consulting, impacting companies like Accenture, Booz Allen Hamilton, and Deloitte. Hegseth did not mention any termination costs, though, that might be associated with canceling those contracts. And that's your brief, John.
Hey, Danny, thank you. More from Danny later this hour. Numbers from Morgan Stanley dropping at 7:30 Eastern Time, so about 17 minutes away. Up next on the programme, Beijing retaliates.
We'll see what happens with China. We would love to be able to work a deal. I have great respect for President Xi, and I think that we'll end up working out something that's very good for both countries.
In just a moment, we need to talk about commodities. Crude down since April 2nd by 16%. Up next, the Energy Secretary, Chris Wright from New York. Good morning. You've got 2 options in a moment like this one. You can listen to what the banks are telling you, or just read the numbers. Read the numbers. the guide's pretty decent from JP Morgan this morning. Maybe it's difficult to guide in a moment like this one, but the guide is pretty good for the rest of this year. Offers some support to the equity market, up by 0.4% on the S&P, on the Nasdaq, up by 0.4% also. Under surveillance this morning, Beijing retaliates.
We'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries.
So here's the latest this morning. China raising tariffs to 125% on all U.S. goods after the White House clarified China faces a 145% tariff rate on exports to the United States. I'm pleased to say that joining us now is the 17th United States Secretary of Energy, self-described energy nerd turned entrepreneur, now dedicating his time to public services. Mr. Secretary Chris Wright, thank you very much for joining Bloomberg Surveillance this morning. We appreciate your time. We just wanted an initial reaction from you to the tariffs we heard retaliated by China overnight. What's your reaction this morning, sir?
Oh, I think you see we're right in the midst of a negotiation. This is home territory for President Trump, both in his business career and his first term as president. You know, he reads the marketplace, he engages with people, he uses leverage, and we're going to get to a great result. We're seeing the midst of it right now, but I'm quite optimistic about where we're going.
Well, the United States has already slashed its forecast for global oil demand. If we continue on this path of a trade war, do you expect demand to continue to decelerate?
Oh, their prediction of the demise of demand growth for oil is older than I am. So, look, there's cyclical factors on economic growth that do impact that. The long-term growth rate of oil, a little more than 1 million barrels of oil per day, per year, has been going on for decades. I don't see any big change in that in the foreseeable future. You see a marketplace right now that is worried about economic growth, and I think you're seeing some softening in oil prices from that. But I think that fear is misplaced. I think we're going to end out in a better economic situation than we went into this Trump term, I think by a long shot. Look, two things are driving tariff policy for President Trump. One is we've been very welcoming to exports from other nations. We want other nations to be just as welcoming of U.S. exports so we can grow our exports more in line with our imports. And President Trump wants to see America reindustrialized, investment, jobs, and heavy industry back in our country. Both those are going to be wonderful for the United States.
Well, it's not just a softening of oil prices. Mr. Secretary, I'm sure you've seen that since Trump's inauguration, prices are down more than $10. At what level do you think you can see drill, baby drill, as the president likes to call it, when it comes to shale producers? Because what we're hearing is that they cannot do this if prices fall below $50 a barrel.
Yeah, look, investment decisions of oil and gas companies in the U.S. and abroad are based on a little bit of multi-year view of oil and gas prices. They're not moved based on the spot price of oil today or oil last week or oil next week. So these are longer-term decisions that are being made. We saw oil and gas prices move down immediately after President Trump was elected. And that was the market seeing, oh, yes, all the nonsense that's tried to kill the oil and gas industry, promised it'll be over soon, stop giving permits on federal lands. All that stuff is going away. And so there's much more of a green light on production. So if you put more supply into a marketplace, you're going to get lower prices. Now we're seeing, as I said, that sort of extra fear of world economic growth in the next few months over the tariff dialogue. That's real fear, but I think the marketplace may be discounting the wrong answer here. We're going to see very, very positive economic growth in the next few years.
But is it still realistic to be talking about the United States adding another 3 million barrels of production at these prices?
Well, I think you're referring to Scott Bessent's plan there, and his 3 million was 3 million barrels of oil equivalent. Most of that growth will come from natural gas. And of course, the domestic demand for natural gas with the growth of AI, resourcing manufacturing, and our surging exports, boy, we will grow oil equivalent production by at least that much during President's term. But we will also grow oil production and other natural gas liquid production in the United States as well. So absolutely. Are we going to see strong growth in American energy production? 100%.
Mr. Secretary, you've been on a tour in the Middle East for about 2 weeks, and it's our understanding that before Saudi Arabia decided to add even more barrels to the market, there was a conversation, a dialogue between the Trump administration and the kingdom. Can you give us a sense of what that dialogue looked like? Is the United States supportive of OPEC Plus adding more barrels to this market?
Yeah, we don't directly coordinate on oil production policies or whatever. That's certainly in OPEC's purview. But I don't think anyone in the world misunderstands President Trump's desire to see more energy produced, therefore lower prices and more economic activity. Absolutely, that's President Trump's agenda. Look, his agenda can be summarized as prosperity at home and peace abroad. Lower oil prices help both of those. And the peace abroad that's of most concern right now in the region where I am in the Middle East is Iran. During the Biden administration, oil prices were higher. There was sort of an appeasement attitude and no strong enforcement of sanctions, enormous funding to Hamas, to Hezbollah, to the Houthis, and a rapid advancement of their nuclear program. President Trump's agenda is exactly the opposite of that. It's peace through strength, but we simply cannot and will not accept a nuclear-armed Iran.
Well, when it comes to Iran, we saw even more sanctions on the regime yesterday. When it comes to these oil sanctions, the president has said he wants to go back to maximum pressure. Is that part of the conversation you're having with Gulf allies on this tour, that they'd be willing to step in if some of those Iranian barrels come off the market?
Well, fortunately, just from the United States production itself and the size of the global oil market today, absolutely we can tolerate squeezing out Iranian exports. And of course, do all the Gulf neighbors want the same thing we want? Yes. Do they fear a nuclear-armed Iran? Absolutely. Do they think now is the time to turn the screws and end Iran's nuclear weapons program? Absolutely. But yeah, can the world tolerate that? Absolutely. 10 years ago, 20 years ago, could this have happened? No. But today we both have large American oil production, better relations with our neighbors, and a strong, resolute leader. In 40 years of trouble, 45 years of trouble from Iran, we've never had a better chance to reduce Iranian power, reduce Iranian tyranny in the Middle East, and we don't want to miss that opportunity.
Mr. Secretary, the president has said a lot, even recently to me on Air Force One. He likes that oil prices are coming down. Do you and the president have a price in mind?
No, I think my whole life I've avoided predicting prices or dictating prices. You know, we have a wonderful free market economy. That's what makes the world wealthier. That's what allows consumers to continually re-express choices in every direction. So no, there's no formula for a good oil price. There's just a broader belief that lower cost diesel, lower cost gasoline, lower cost home heating, lower cost electricity, all of those are good for American consumers and good for businesses. That's President Trump's energy agenda, and I'm here to implement it.
Mr. Secretary, appreciate your time this morning, this evening where you are. Thank you very much for being with Bloomberg TV. The Energy Secretary there, Chris Wright. The key headlines from that particular conversation. So the first real cabinet official to come out and respond to the tariffs from China overnight, calling it a negotiation. This is what we heard about demand. Lisa, concerns over oil demand are misplaced.
Yeah, that basically this is not going to be a global recession. He didn't answer the question about what this means for drill, baby, drill, and what this means for shale producers, because ultimately, given how much the U.S. produces, are low oil prices a good thing or a bad thing for the United States?
It's hard to understand from this administration how low they want to see oil go, because you can't drill, baby, drill if it's closer to $50 a barrel. At the same time, they want to see lower oil prices because they think this will feed into a lower inflation number and an ability maybe for the Fed to cut rates.
Crude just about 60 this morning. Brent crude and WTI down double digits since April 2nd. We are lower by about 0.1% so far this morning. Up next, numbers from Morgan Stanley and reaction from Gerard Cassidy of RBC. Big morning for bank earnings. Equity futures this morning positive by about 0.25%. Those gains are fading at the moment on the S&P, on the Nasdaq up by 0.2%. With 2 hours until the opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. The banking stocks are still flying high this morning. Earlier, hearing from JP Morgan, a big beat on trading, a record quarter, alongside an increase in net interest income. We also just heard from Morgan Stanley, a beat. Shanali will break that down in just a moment. But for now, all these shares up at least 1.33%. Now, we also have on the move this morning as well with BlackRock. This one's interesting because it's also getting an uplift with JP Morgan earnings. Originally, when BlackRock reported earnings, shares fell because their inflows missed estimates. But then you get this good quarter from JP Morgan, and there you have it. Shares up 2%. All financials rallying, even though you had Larry Fink basically saying every client conversation is fear and anxiety about what the future holds, likening this to other crises of the past. Finally, ending this with a company that has had a rough go of it as of late. Stellantis in the pre-market trade down 2.8%. Its shipments fell 9% over the past 3 months, specifically some problems in North America over holiday periods when factories weren't operating. In January, those shipments fell 20% from North America. And of course, all these figures don't yet take into account what damage they might see from the tariffs. John.
Hey, Danny, thank you. More from Danny later on this hour. In markets, there is good volatility, there is bad volatility. If you were trading equities in the first quarter, I think it's fair to say there was good volatility. Shanali Basak has more. Hey, Shanali.
John, this report has Ted Pick written all over it. You're looking at equities trading revenue coming at more than $4 billion for Morgan Stanley. That is handily not only beating analysts' expectations, it is also beating out JP Morgan. Another critical metric, you saw Morgan Stanley beat out JP Morgan, and I don't remember how often this happens, but not very often. It is the return on tangible common equity came in at 23%. Absolutely stunning in this type of environment. You also have them missing, however, on their margins for the wealth management business. There will be questions around how both retail and institutional clients are behaving in asset management and trading. However, the Wall Street numbers, debt underwriting also beat estimates at Morgan Stanley. They had a strong beginning of the year. That's going to be another big question as the year goes on, given the capital markets freeze. Ted Pick's heart is in that capital markets business. They've been trying to win back that share in equities, and you see the banks leaning in and taking on risk to help these markets gain steam.
So, Shanali, you did a bit of compare and contrast. Do a bit more if you can, please. Look ahead to next week. We've had Morgan Stanley, we've had JP Morgan. Look ahead to Bank of America and Goldman, two similar banks versus those two. What would you expect to see next week?
If I was sitting inside of Goldman Sachs' trading desk and watching Morgan Stanley put up $4 billion, boy, I would hope that they're putting up more. This has been an insanely competitive business in recent months, John. And I've got to say, I went back years in this break through JP Morgan's results. They have not put up this type of value at risk since 2020 and 2021 for equities and commodities. So the trading desks are working very, very hard here. At the same time, for Bank of America, Lisa made this excellent point earlier about reinvesting securities. Who does that matter more for than Bank of America? And so interesting, but the bar is also high, given we did see JP Morgan raise the bar for net interest income and Wells Fargo keep that bar high.
Shanali, just before you go, we caught up with Gerard Cassidy earlier. We'll speak to him again in just a moment, and we reflected on how unusual this quarter was. Given the policy volatility we've seen from Washington, D.C., I think it makes the calls all the more important with the CEOs and the C-suite over the next few hours. Which are the ones that you'll be listening for later this morning?
JP Morgan, number one, even though we've heard from Jamie Dimon a lot, there is a lot of positivity behind that cautious tone he's taking up front. Headcount rose, if you could believe it, John, at JP Morgan. And at Morgan Stanley, even though they're cutting jobs, you do see them having efficiency better than what was expected, which would mean that maybe they can hold tight for now, that it's not as bad as people are screaming about, at least at the moment.
Shanali, appreciate the update. Bloomberg Shanali Bassett breaking it down. Morgan Stanley numbers, two headlines. Wealth and equities very important to them. Wealth management in the first quarter, net revenue $7.3 billion. The estimate $7.44. The first quarter for equities trading revenue came in at $4.13. Lisa, the estimate there $3.42. That's a tidy upside surprise.
So the funny thing about this earnings season is we've seen that volatility for equities, at least equity trading, has been good for For the big banks, as you said, this has been a profit center and it has been bad for bonds. It is the opposite when it comes to underwriting. Fixed income underwriting beat expectations, whereas equity underwriting missed expectations from Morgan Stanley. Basically, think about it this way. A lot of volatility in stocks. Who's going to IPO right now? And this goes to the point that the advisory revenue came in a lot lower than expected. That is going to be one of the key questions for Morgan Stanley. Are those deals derailed or are those deals delayed? Because right now, this shows that trading is making a comeback at the expense, maybe, of the primary capital markets.
Perfectly framed. Let's get Gerard Cassidy of RBC into the conversation to talk about that. Gerard, that's been our question of the morning. Some of that activity delayed or derailed for the rest of the year. How do you come down on that question?
At this point, John, I think we can go into the camp of delayed. It's a little early to call it derailed. We're obviously only 4 months into the year. A lot is going to change over the next 8 months. So as the second quarter unfolds and we get a better understanding of the economic policies coming out of Washington, especially about the tariffs, I think that will give us a better understanding whether this investment banking business is, derailed. Right now, we don't think it is, but it's going to be really dependent upon the stability in the markets, as Lisa pointed out, as well as what the outlook is for the economy.
There are different banks with different profiles. Morgan Stanley, I think of as being more hinged to both the banking and the advisory side of things, the investment bank, as well as wealth management. Wealth management has been a pillar. They have been trying to grow that. That missed again. How big of a liability is that potentially to its growth plans and at a moment like this, to its ability to capture some of the gains in interest?
It's going to be interesting because wealth management has had a great tailwind for the entire industry for a number of years. And now we're into these more volatile markets that, of course, weighs on the wealth management business, though there always has been the expression buy the dip. That's been, so far a bit challenging. So the wealth management numbers, Morgan Stanley has done a phenomenal job, over the last 10 years, building out their wealth management business. James Gorman passed it on to Ted Pick. They're continuing building out that growth, but it is volatile. It's not linear. And so it's really going to come down to what, the markets do and whether the wealth management retail investor comes back into the market in a big way.
How do you explain, Gerard, the fact that we're hearing some really negative rhetoric from the banks? They are increasing their loan loss provisions. We saw that again, provisions for credit losses exceeding expectations at Morgan Stanley as well. How do you square that with what we're seeing, which is booming revenues and booming expectations for profitability at these big banks?
It's an interesting question. And as we were chatting a moment ago, it's all due to this new accounting standard, CECL, as we call it, current expected credit losses expectations, that is. And so CECL requires the banks to factor in the outlook for the economy in building those reserves. And it's been the consensus call that the policies out of Washington will slow the economy. Generally, in a slower economy, you have greater credit losses. So the current expected credit losses, again, CECL, require the banks to build up these reserves, even though they're not seeing any evidence of credit losses, to your point. So it's an interesting dynamic that this is the first time we're really seeing it play out, not excluding the pandemic period. So we'll see how the banks handle it. But what it shows us is the banks are well capitalized. They're buying back their stock. I don't know if you saw the buyback at J.P. Morgan, over $7 billion in the quarter. So what you're going to see is that the banks so far can handle these higher credit provisions and still deliver very strong profitability.
So far, we have Jamie Dimon saying clients have become more cautious amid an increase in market volatility driven by geopolitical and trade-related tensions. And Wells Fargo's CFO is saying customers continue to be resilient. Can you be both resilient and cautious?
I think you can. Resilient, tells you that, the customers are strong. Doesn't mean they're growing. But to Dimon's comments, that is, in my view, more of a growth outlook for his customer base. And they're also, obviously, at J.P. Morgan, resilient as well. So that's the other thing coming into this. The consumer and corporate balance sheets coming into this year, coming into this quarter, are resilient. And so it's going to be interesting to see how we navigate through this. We all recognize it's going to be choppy and more volatile. But this is not a 2008, 2009 for the commercial banks at all. It's probably more more like '01, when, believe it or not, the sector was considered a hideout sector. And so that's going to be interesting to see how that plays out in the upcoming year.
Gerard, I'm so glad you mentioned the share buybacks that we heard announced from JP Morgan. We heard something similar from BlackRock, which I find fascinating and what I'm waiting for this earnings season. How many companies are going to say, my shares are on sale? I'm going to buy some. I'm going to give you some negativity on the front end. On the back end, I'm going to buy some shares so that I cushion any potential blow. These banks aren't really giving any negativity, at least in their actual earnings, but they are buying on the backside. How much does that support your view for some of these big banks in terms of valuations?
Lisa, you put your thumb right on it. I think it's a real important part of the valuations and what goes forward. The industry is overcapitalized. We have new regulations coming, the so-called Basel III endgame. We expect that those capital requirements will not move much higher for the biggest banks, although they were building up capital over the last 2 years in case that was a requirement. So now they have this excess capital on their books. We've heard Treasury Secretary Bissett make it very clear that the corset around the banking industry from a regulatory standpoint has been too tight. He wants to loosen it up, which means there's going to be more capital to be used to give back to shareholders in dividends and buybacks. It's going to be an important part of the return this year.
Hey, Gerard, thanks for making time for us this morning. Appreciate it all. I know you've got to catch up with clients. Gerard Cassidy there of RBC, wrapping up the big banks on Wall Street. We've heard from JP Morgan and Morgan Stanley, and so far, so good. Reminds me of a quote that came from Savita Subramanian at Bank of America in just the past week. Savita said it's dangerous to underestimate companies on the S&P 500. Savita is about 20 minutes away. With an update on stories elsewhere this morning, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John, a quick recap of Morgan Stanley earnings, which, by the way, are up more than 1% in the pre-market. It reported first quarter trading revenue that topped Wall Street estimates. It surpassed $4 billion, beating even JP Morgan's quarterly figures for equity trading. Morgan Stanley's wealth management revenues did, though, slightly miss estimates. New assets in the division were roughly on the same level as last year. And a Morgan Stanley strategist issued a report to clients, redacting several passages about President Trump's tariffs. Michael Sembola said it was the first time that he's had to weigh the impacts of his words beyond typical market and economic implications. Sembola said people are being held accountable for their views in ways that they probably shouldn't be. ByteDance's revenue increased 29% to $155 billion in 2024, driven by TikTok's global expansion. TikTok's fate, though, still remains uncertain in the U.S. Last week, the Trump administration granted a second 75-day extension to work out a deal. And that's your brief. John.
Hey, Danny, thank you. Appreciate the update. Up next on the program, questioning America's safe haven status.
It turns out that's the beginning of the volatility in bonds, not the end. Investors are not viewing treasuries in the same way that they did or they used to in past crises.
It has been a really strange week. You don't typically see weeks like this one, with bond yields higher by about 40 basis points on the long bond. And in the FX market, the dollar's weaker, not stronger. What is going on? Greg Peters joins us next at PGIM from New York. This is Bloomberg. Don't blink. Things can change quickly, but at the moment on course for the biggest weekly gain on the S&P 500 of the year so far. Equity futures on the S&P up by 0.2%. On the Nasdaq up by 0.2% on the session, even with the retaliation from China overnight. If you're just waking up and tuning in, they retaliate with 125% tariffs of their own on US goods. In the bond market, what a week it's been. On the week so far, 30-year bond yields are up by more than 40 basis points. This morning, 486.51. And even with a move like that, typically you'd expect some dollar strength. You did not get it. You're getting dollar weakness. DXY is down this morning by 1%, down on the week by 3%. What's happening? Under surveillance this morning, questioning America's safe haven status.
It turns out that's the beginning of the volatility in bonds, not the end. So the next 90 days is going to be quite volatile in the bond market. When you have sort of a little bit more of a crisis of confidence, if you will, then you're going to see that bias towards higher yields. Investors are not viewing treasuries in the same way that they did or they used to in past crises.
So So here's the latest this morning. Investors confronting higher bond yields and a weaker US dollar as Treasuries offer little comfort to anyone looking for a safe haven. Greg Peters of PGIM expecting trade uncertainty to linger and writing the bond market is still extremely fragile. Greg joins us now for more. Greg, welcome to the programme, sir. We've got a bit of time with you, so let's take a big step back. What's been going on in the bond market this week, particularly at the long end?
I mean, uncertainty doesn't do it justice, right? I think my old colleague, Subhadra, really nailed it. There is concern around the risk parity characteristics of owning bonds. You're seeing the dollar kind of react the same way. So if bonds aren't going to provide investors that risk match, that comfort when risk assets sell off, that bonds would help out a more balanced portfolio, then it really begs the question, why own them at all? And so that is the overarching issue that I see from a bond market perspective. But then you have lots of other technicals going on. You had a slew of auctions. You have a lot of stop out and unwinds from positioning, and it was just a bunch of events all hitting at the same time.
Can we talk about one of those events? Quite clearly, the risk mitigation characteristics of a 10-year bond, a 30-year bond have been damaged. Just judging that on the performance so far this week relative to the volatility we've seen elsewhere in risk assets. Greg, there's one element, though, that keeps coming up, and I keep hearing it from lots of different people. They're asking the same question. Are we seeing the Japanese, the Chinese dump US debt? Now, typically, I'd sit here and say, well, let me turn to foreign exchange and see if we've got any dollar weakness. And typically, I'd see yields up, dollar stronger. This week almost lends some fuel to that theory. Greg, what do you see and what are you hearing?
Well, I don't think we'll know for sure. That is what's being discussed in the marketplace. Some of the flow data does seem to suggest that, has occurred. The price action should, strongly suggest that something's going on. Either way, you're not going to see, and you're not seeing the same foreign demand, in the U.S. Treasury market, right? That has, continued to be less and less, over time. Both China and Japan, less today than they were, 5-10 years ago. Europeans have stepped up recently, but I think this is just the beginning of the story, right? So if you're containing trade or constraining trade, then the demand for those dollars, the demand for those treasuries also dissipate as well. So this is a natural byproduct, by the way, of trying to change the contours of trade. It makes the dollar less important and owning treasuries less important as well.
Greg, you said that this is the beginning of the story. Can you extrapolate out and tell us a little bit more about this story, what it looks like, how much you've changed your outlook over the past week or two?
Yeah, so this is something that I think will go on for quite some time. I actually think we're embarking on, a radical shift in, the world order, so to speak. And I think it's going to have profound implications on investing in the U.S. And that it impacts the dollar and it impacts U.S. Treasuries. It's just hard to kind of reset and say, no, I'm just kidding type of thing. So I think this is something that is permanent or semi-permanent, and the risk premium in both the dollar and treasuries is not going to quickly dissipate, if at all.
What does that mean, Greg, in terms of what you're doing at PGIM? Are you selling treasuries and going into boons? Are you reducing your overall exposure to the U.S.? How much are you just going to cash to try to figure out how things are going to rearrange in the future?
Well, it definitely makes it more tricky, for sure. So we've been pretty light risk going into this, episode. We were worried about, some of the policies really having an impact on consumer sentiment, at all. We were long duration, but, really kind of flattened out here. It does make it very difficult. But, to your point, it is a global marketplace and the global environment is actually pretty good. So the dislocation's good, for managers like us. And we're seeing opportunities and value outside the U.S. And a natural positive here is that correlations are breaking down, right? As the dollar's decoupling, as U.S. rates are decoupling, that creates opportunity globally. And up until recently, it's been a dollar-driven U.S. Treasury world with a correlation of 1. So that's one of the positive benefits from an investing standpoint.
This seems like a superficial question based on some of the reordering of the global trade sphere, as you say it. But how high would Treasury yields in the long end have to be to entice you back?
I don't know. I mean, it's kind of a Jenga, right? There's lots of different, moving parts. I mean, you look at where swap spreads are. You look at other valuation metrics. Treasuries do look attractive, but with the foreign demand, moving away, I've seen calculations that that's anywhere from 30 to 50 additional basis points, right? So there needs to be a clearing level, right? There's so much debt coming and continuing to come. There was lots of focus on the auctions this week. That focus was appropriate, but it's important to remember that they're coming again and again and again. And so there's just an unrelenting supply. And I do think you'll need more from an extra risk premium standpoint and the volatility standpoint. So I don't think we're there yet, quite honestly.
When do you think we'll get there? The president yesterday spoke about this, signaled really that he understands what's going on in a sense with the unwinding in the Treasury market. He says there's going to be a transition cost, transition problems, but in the end, it's going to be a beautiful thing. What does the end look like?
I don't know, but it doesn't look so beautiful to me. I don't know. I mean, I'm humble enough to kind of state that I'm not sure where the end is. And we're not sure what the permanent repercussions are. Right. But if you just look at the policies on surface with less trade, then there's less need for U.S. Treasuries outright, right? And the domestics have to step in, and there's not a real incentive structure for U.S. domestic holders to invest in Treasuries. So there has to be some other changes. There's a tension on SLR, which I think helps on the margin, but it's far from a cure-all. So I think we're a ways to go, and I'm not convinced that there's a great understanding of this transmission mechanism going haywire.
Would you like a final word on Arsenal?
Yes, it was a great result the other day, that's for sure. So, second, it's not first, but it's better than, it's better than, the alternative, let's say.
That's better news, Greg, that's for sure. Greg Pittis there, of PGIM Fixed Income. A happy Arsenal fan. Given all the volatility taking place in fixed income, this note from Morgan Stanley just moments ago, not out of the woods. I think a lot of you feel that way right now. And the capital allocators dilemma, and it's a major dilemma, this bond market, and we've repeated it on this programme for a number of months now, this bond market is behaving in really unpredictable ways, and we've seen evidence of that again through this week. And it's been exacerbated with the potential rumours of foreign sales as well as possible basis trade unwinds. But what Greg just said there was really key, that the whole goal of this administration of reducing trade structurally changes the investment opportunity in the dollar and U.S. Treasuries. And that, I think, is what bond fund managers around the world are grappling with. We're all struggling to adjust to that reality, if that is indeed the new reality. Bond yields this morning down by 4 basis points on a 2-year. Further out along the curve, we've been all over the place. The 10-year's down by 2. The 30-year is just about unchanged. On the week so far, it's up by around 40 basis points. A major sell-off that we've seen at the long end of the curve that has unnerved the White House. Up next on the programme, Savita, Subramanian of Bank of America, Dan Ives of Wedbush, Veronica Clark of Citi, and Tony Crescenzi of Pimco. From New York, this is Bloomberg.
Anyone who says they have certainty on where the growth outlook is going, where the tariff picture is going to settle, is probably exaggerating somewhat.
We just don't know yet what the impact will be.
Concern is that you need to see stability in the data. You need to see some level of clarity.
Macro volatility uncertainty will trump the deregulatory positive catalyst.
There's probably less than 3 people in the world that know exactly, what the future looks like.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I just think we're totally desensitized now. China overnight imposing 125% tariffs on US goods. Jamieson Greer, the US Trade Representative, turning around and saying that's unfortunate. That's where we're at right now. Equity futures barely blinked on the announcement. Equity futures this morning just about positive by 0.4% on the S&P. This week has been wild, up 3.8% on the week so far. If we close right now, after Thursday, the biggest weekly gain of 2025. That's the good news. Here's the bad news. In the bond market, the 30-year yield has seen a move of more than 40 basis points on the week. More than 40. 487 on 30s this morning. And that's come with dollar weakness, not dollar strength. That's problematic. If you're a capital allocator right now, this bond market is performing in really unpredictable ways. And the FX market's not offering you anywhere to hide either. The dollar, 99.85, down 1 percentage point this morning and down 3 on the week so far.
What Greg Peters of PGIM Fixed Income just said, to me, really does highlight how much people are looking at what's happened over the past 2 weeks as monumental and shifting the course of financial history. People are thinking if you get your goal of the United States actually removing itself as the major trading partner for a number of different companies or countries or putting up the walls, that changes the dynamic for the dollar and the investment case in U.S. Treasuries, and that has to reset how they think about the risk mitigation properties of this asset class. Suddenly, that fundamentally challenges the 60-40 and a whole host of different credos that people have been coming up with in the investment world.
This is what Mohammed Al-Arian said out on X in the past 24 hours. Very gradual but consistent diversification at the margin by some countries in response to what they see as an erosion in America's long-standing safe haven status. Policy volatility at the epicenter of these themes.
And the president is calling it what? Transition costs. We're in a period of transition. At the end, he said it's going to be a beautiful thing. And a lot of people you talk to say, I don't actually know, like Greg Peters, where that end is. You bring up a great point, Jonathan. Markets right now barely even moving when China comes out and says the United States is a joke with their trade policies and they're upping their tariff rate to even higher. Interesting. Jamieson Greer saying it's unfortunate, but Secretary Wright tells us on this program it's the start of negotiations. It's the art of the deal.
It's a negotiation. Transition costs. Who has to pay the price? Equity futures at the moment positive by 1/3%. Coming up this hour, we'll catch up with Savita Subramanian of Bank of America on a wild week for equities. We'll speak to Dan Ives of Wedbush as Apple hopes for an exemption, and Veronica Clark of Citi looking for the Fed to cut rates. We begin this hour with stocks fluctuating as earnings season kicks into full gear. Savita Subramanian of Bank of America writing, first quarter beats and misses may not move the needle as much as in recent quarters. There is a reasonable probability that absent some resolution or clarity, transparency could be compromised. Savita joins us now for more. Savita, good morning.
Good morning.
Reflected on the bank earnings so far, and so far so good. And there's a line that you used over the last week that it's dangerous to underestimate companies on the S&P 500. How dangerous is it?
Absolutely. Well, I think that my mantra is own cash and stocks, sell bonds. Because if we're in this environment of inflation, of, even lower growth, I think that's a terrible environment for asset classes that have no optionality. When you think about stocks, they have lots of options. Companies can pull forward cash return. They can, they have creative accounting mechanisms. So there's a lot of optionality that companies have that the bond market doesn't. When I think about earnings this upcoming quarter, who cares what happened in Q1? I think the focus is going to be on guidance or lack thereof. So what worries me is that a lot of companies have intimated that they have to pull guidance. And we saw this in 2020 with COVID. It's not great. So what we found is that companies that pull guidance, that used to issue guidance, typically underperform on average by about 3% until they actually start giving us guidance. So it's understandable that these corporates can't give us guidance. Who knows? I mean, it's a very uncertain environment. But that transparency that we used to have in the S&P 500 has been compromised, and I think that's the key risk.
Can we talk about the playbook for you and the team? Have you spent some time on the stagflation playbook?
We have. We've spent a lot of time on that playbook. We've spent a lot of time on the tech bubble, derating playbook, 2008, and I think this environment rhymes with all of those. During a stagflationary environment, you wanted to be in stocks over bonds. You wanted to be in value over growth. So you wanted to basically buy cash and cash yield. And that's where large cap value comes in. And that's still, I still see this as a very unusually attractive size and style box in the S&P 500. Nobody talks about large cap value anymore because it hasn't worked for such a long time. But if you think about these companies, these are, kind of big companies that have rationalized capacity, are focused on returning cash. Energy companies have transformed their philosophy from drilling and capex to cash return above everything else. And these are companies that actually benefit from a little bit of inflation, which we're likely to get if we see these tariffs go through in any way, shape, or form.
How much are you looking at companies that are really domestically based too, and not necessarily international?
So this is the tricky part, because a lot of companies that are domestically based are the buyers or suppliers or in some way maybe more vulnerable than the multinational companies that actually have the foreign exposure. So I think that's where you really want to dig down and see what their externalities are, what their dependencies are. And if that's on, if you've got a domestic company that's dependent on a big MNC, it's not a great situation. This is why I don't think small caps are really the safe haven in this type of environment. I think what's interesting, though, is if you look at the multinationals, they may have more options than we think. So I think tech aside, other companies in the U.S. have shown a lot of resilience during periods of macro volatility. So, think about what we've experienced over the last 4 or 5 years. We've had inflation go from negative to 9% to 3%, wherever we are now. And that could go higher. But during that period, U.S. corporates actually saw very little in terms of margin risk. So I think that's the lesson that we have today, is the idea that we could actually see margins hold up better than expected.
A week ago, you downgraded your expectation from the 6,600 range to 5,600, which is still an upside from where we are today. And I just wonder what leads that, if it's not going to be big tech, and if potentially you have bond yields that are not going to be cooperative into potentially a stagflationary type of environment.
Yeah, I think large cap value gets us there. I think
without participation of tech.
Tech could flatline, tech could even go down as it has already, and we could see the market end a little bit higher. And I think the idea is where we haircut our target is not necessarily the equity risk premium, but really the risk-free rate. And if you think about it, the risk-free rate is the 10-year T-bond yield. And that has all of a sudden taken a step function higher in terms of its risk. I mean, foreign demand, we've got a buyer's strike. There's still a lot of U.S. Treasury bonds owned by foreign regions. So I think that's the risk, is that you see that risk-free rate no longer be risk-free. And it's actually one of the riskiest areas in the capital market spectrum. That said, when you look at companies that can benefit from rising rates and rising inflation, that really firmly falls into that value bucket. It's energy, it's even financials. Financial companies, big financial companies have delevered and are actually in a pretty good place right now if we still want America to grow. And I think that's part of the policy mantra, is make America grow again. Who's going to lend money to these companies? Probably some of the larger U.S. banks. So I think that's the next leg. Energy is a great place to be if you're in a stagflationary setup, absent a recession. I don't think we get the Fed to cut, because I think, that would require a meaningful downdraft in inflation that they're just not seeing. So we have the Fed on hold this year, and that's an environment where you still want to own cash return, anything that's got that short duration, characteristic.
When it comes to trade and tariffs, do you think the risk is that it hits earnings more or actual growth?
It's a good question. I think it hits growth in the near term, because it's very difficult to plan and do anything when you don't know what the playing field is going to look like. That said, companies have generally been able to navigate periods of uncertainty. And I guess I would highlight, we're always in a period of uncertainty. I mean, today we know that President Trump came out with this package that's potentially worse than expected. But, 2 years ago, we could have had the same type of uncertainty. We've had COVID, we've had other types of shocks that corporates have handled. So I guess I look at this and I think, okay, companies are sitting there kind of waiting for clarity, but we know that China is the culprit here. We know that that's where the U.S. is playing hardball. We've had a stay of execution on other regions, at least for 90 days, or, we'll see. But I think that at least we know kind of a little bit more than we knew prior to Liberation Day.
We played this game back in 2018, and it was far worse for equities, far worse for credit, and the tariffs were nowhere near as high as they are right now. How instructive is the 2018 example for you?
Well, 2018, I think, was interesting because companies were pretty good about being able to shift their sourcing models. So what worried us after April 2nd was that it wasn't like you could shift your sourcing model somewhere else. It was like everything was under siege. Today, I think that's a little bit mollified by the fact that we've seen, this potential for negotiations outside of China. So I think that's a positive. But when you think about the tariff setup back in 2018, even before that, companies had been pretty aggressively shifting sourcing out of China to other regions of the world. So I think that's the other kind of takeaway, is that half the economic activity that we used to do with China has been shifted to other parts of the world.
Is it just too difficult to internalize some of these numbers being thrown around? Are they just so large that people don't think they're going to happen?
Well, yeah. I mean, I think that, going above 100% on tariffs, like our unitary elasticity model breaks down. I mean, there's, it's very difficult to model that in. But I think the idea is that's the region where we're really going to see trade limited.
Yeah.
But the good news is we've already been in an environment where companies have been reshuffling away from China to other regions of the world.
Just feels like mutually assured destruction. People see them going on, they don't think they're going to last very long.
Because they're just too high and it can't work. It's full decoupling. You have to ask the question, though, is it also de-risking? Is the United States going to make sure that they don't get things like high-end chips? The one thing I will say about these numbers is we know Trump likes to start from a maximalist approach. Well, they're above what he promised on the campaign trail, which was 10% around the United States and up to 60% on China. So I think if you're looking at this play out, and it is going to be art of the deal, then maybe that's where we end up, what he promised.
145 and going up at the moment. I'm not sure they've stopped. Savita, it's good to see you. Thanks for dropping by.
Good to see you too.
Thanks for being here. Savita Subramanian there of Bank of America on this equity market. Equities at the moment positive by a third of 1% on the S&P. With an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. We start with the tragedy in the Hudson yesterday. A helicopter crashed into New York's Hudson River, killing all 6 people on board. City officials say the passengers, including 3 children, were from Spain. The helicopter's flight path shows that it had flown around the Statue of Liberty and George Washington Bridge before the crash. Elsewhere, Mexico is vying to protect its auto shipments to the U.S. in the wake of President Trump's 25% tariffs on cars. A trade official says that the country is looking for ways to move parts of the production process to the U.S. in order to increase the deduction. The official said that Mexico's goal is to have the lowest tariff rate of any other country in the market. Officials from the U.S. and Iran are set to meet in Oman to discuss Iran's nuclear program tomorrow, the highest level talks since 2022. The talks are complicated by a deep distrust between the two sides. The U.S. is seeking to prevent Iran from developing a nuclear weapon. Iran wants sanctions relief and recognition of its rights to enrich uranium. And that's your brief. John.
Danny, thank you. Good luck with that.
It's not going to happen.
It's not going to happen, right?
Not enriching uranium. And then you have to also think about, is Trump going to be after if he wants a deal about whether or not the Iranians are able to support their proxies? I don't see that happening under this administration.
That's the ask anyway. Up next on the programme, the Morning Calls Plus, Dan Ives of Wedbush as Apple hopes for an exemption. That conversation just around the corner. Equity futures right now positive by 0.4% from New York. Good morning. The opening bell just around the corner, 1 hour and around 13 minutes away. Equity futures positive still. We'll see if this holds. We'll see if it sticks. We're positive by 0.4% on the S&P. On the Nasdaq, we're up by 0.5. Let's get you some morning calls. First up, Bank of America upgrading American Express to buy, saying the credit card provider is recession resilient. OK, the stock is up by 2% in the pre-market. Your second call from Mizuho, initiating coverage of Walmart with an outperform rating, calling the company a must-own name in the consumer sector. That stock is up by 0.5%. And finally, Citi cutting its price target on Nvidia to 150, citing economic uncertainty due to the ongoing trade war. Sticking with tech, Dan Ives of Wedbush cutting his price targets on Tesla, Apple and Microsoft this week, writing the following. Max 7 names will be front and centre in this economic period of uncertainty. No US tech company is more negatively impacted by these tariffs than Apple, with 90% of iPhones produced and assembled in China. Dan joins us now for more. The Rodney Dangerfield of finance. Good morning, sir. I thought that was cruel.
I think it was, look, again, who wears a Hawaiian shirt to an economic Armageddon? But
One guy.
You do, apparently. Yeah. You promised me a black suit, though. One day we're going to make that happen.
I did promise. And then
With stocks down this much?
Look, I mean, it continues to be, in my opinion, 25 years doing this job, from dot-com bubble, financial crisis to COVID. It's the scariest week and some of the scariest conversations that I've ever had in my career.
What's so scary about them? Just give us some color on that.
It's the economic impact of what I still think investors and consumers don't recognize. Relative to, remember, we're not talking stocks. Let's just talk about just the pure supply chain. The reality is that tech, the hearts and lungs of the tech supply chain, are in Asia. And you can't all of a sudden call Smith Semiconductor manufacturing in the Midwest for a chip because there's one problem: they don't exist. So they've basically been left in the ocean, boat flipped, no life raft, being like, okay, good luck. We'll talk to you guys when you get to shore. And I don't think the recognition of what this is going to do to pure demand destruction in terms of CapEx, uncertainty, and the reality of what's actually happening here. The snowball, once that starts and goes downhill, you can't all of a sudden just be like, oh, we're good in 2 months.
Well, that's not to mention the fact that they have a huge consumer base in Asia, which also potentially could get cannibalized from everything that's going on. One thing that's amazing about your analysis is you go around the world and you talk to investors, you talk to executives, you talk to the CEOs of these companies. What's the mood right now?
It's like the Michael Jackson Thriller video. That would be the best way I could compare the mood. It is as troubling as I've ever seen, because there's so much nervousness in terms of uncertainty. We don't know our inputs. What's demand going to look like? CapEx, do we cut it now? No one's giving guidance. So, I mean, I just find that as someone that's been the most bullish, over the decades, you cannot go into this earnings season and be like, it's baked in. Look, it's a new reality. And that's why when they say near-term pain, we've talked about it so much. Near-term pain, it would take Apple 4 to 5 years to build a new factory, $30 billion, just to move 10% of the supply chain, and iPhones will be 3,500. We should build them in New Jersey if you like iPhones being 3,500. That fundamentally is the issue in big tech, CapEx, projects. That, to me, is what's so scary in terms of, all the conversations that I've had.
Can you give a sense? Apple seems to be on the lowest end of flexibility when it comes to rejiggering the way it does business in the wake of some of these new rules of the road. What about some of the other tech companies? What about the Microsofts of the world, as well as the Oracles, some of the companies that are integral to a lot of corporate business planning in the U.S. right now?
Yeah, look, software, and we've told investors, defensive-wise, like in this bunker mentality, software is going to outperform. In terms of Oracle, Microsoft, Salesforce, cybersecurity, Palo Alto, CyberArk, among others. But it's still, okay, I ordered a server, $100,000, comes in a rack, so am I going to get hit with a bill 2 months later for another $100,000 in terms of what happened, in terms of what's come from China? So the uncertainty, software is impacted because it's CapEx. They're also driven by hyperscalers, driven by CapEx, driven by the AI, a lot of this spending. So that's why it's the ripple effect that impacts software as well. I think they're the best house relative to this neighborhood, and probably we will say less impacted, but they're not immune, because this is going to impact all of tech. And I think across the board, tech earnings comes down off the gate 10 to 15%, just for starters. And then you wonder, okay, what's baked in from there? Where do we go?
Dan, you're talking about potentially, if it's made in the U.S., a $3,500 iPhone. With a 140% tariff rate, is it still cheaper to make it in China?
And that's why you're going to have $2,300 iPhones, $2,100. And that's why it just comes down to, Annmarie, I think the reality, in Apple, they're in the eye of the storm. They have no flexibility. And you can talk about things like, do they get exemptions? Where do they play? India.
Do they get exemptions?
Look, and again, no one knows. because you don't know rules of the game. And maybe they get some exemptions, but not all exemptions. But then what about A, B, C? What about, do they get exemptions? And I think that's why, from an investing perspective, every other time in 25 years, from financialcrisis.com, you could be able to look through things, be like, okay, on the other side. Here, you don't know rules of the game. You could wake up being like, you drive on the left side of the road, your name's Tim, it's not Dan. And so that's the reality when it comes to these stocks.
Okay, but these companies have had warnings, and I'm not just talking about Trump on the campaign trail. Even Biden was pushing for de-risking when it comes to Beijing and Washington. Trump talked about this in the first term, and there was tariffs in the first term. Why didn't they do more to put supplies outside of China?
Because you basically can't. I mean, the reality is, like, this is a supply chain that's been built for 20, 30 years. The reality is, like, the IP, the way these products are made, anyone like myself that spends so much of my time in Asia, in China, you know, throughout Taiwan, Vietnam, and others, you just can't, we don't have the manufacturing, the consumer cost basis from an employment perspective to actually do that here. And I think that's the whole issue, is that saying it and doing, they're two different, there's a reality and a fictional. And I think that, to us, is why we've been so troubled by what we've seen, because in my opinion, it takes U.S. tech back a decade. It cuts the knees off when it comes to AI revolution, unless we see negotiation otherwise. And guess who the winner is? It's China tech.
So why have you still got to buy on Apple?
Because my view is that if I thought this was permanent and I thought this stays, then you downgrade every stock that you cover. It's the view that this is basically, whether it's 30, 60 days, it's the view that June, September quarters you basically throw out. You start to look at some sort of normalized 2026 number and a baseline situation. So my view is, like, you can't, but John, if you assume this stays for an elongated period of time, then it's game, set, match. So our view, the way that we've navigated, is like,
your assumption it doesn't hold, it doesn't stick, it's that bad.
If this holds, I mean, you talk about Armageddon, like, that would be probably a good term to where I would see that, just given the amount of products that come from China, the supply chain, U.S. tech. We could say it. I could say I want to play in the NBA. I could say it 100 times, but I'm not. Okay, so good.
Thanks for clarifying.
But again, good 3-point shot. But the reality is, that's where I see, and that's why we're navigating investors through this. Software, we're going to worst case numbers and kind of getting some sort of baseline to where you should own certain names if they get to those points.
It's a difficult moment. Dan, it's good to see you. Appreciate your time. Thank you for being here. Dan Ives of Wedbush. It's so bad it's not going to hold. Seems to be the takeaway from a lot of people we've been speaking to over the past few days.
Right, and then you hear from the energy secretary, who's in the Gulf talking to partners about things like tariffs, and he says it's the start of a negotiation. 145%, maybe more. How can it hold?
Only a few days ago, we asked the chair of the Council of Economic Advisors over at the White House whether it was a negotiation or the rules of the game, and we were told it could be both.
Could be both.
So it could be both. PPI data's up next. This is fun, isn't it? Veronica Clark of Citi joins us in just a moment. From New York, this is Bloomberg. Let's just tally up the week, which is difficult to do. As things stand on the week so far, the S&P is up by 3.8% on the S&P 500 this morning, adding just a little bit of weight to the rally, up by 0.4%. Well on course for the biggest weekly gain of 2025 so far, even with China putting 125% tariffs on the United States after US tariffs on China went up to 145%. This has had profound effects on the bond market in unexpected ways. 2-year, 10-year, 30-year. The 30-year yield has risen by more than 40 basis points on the week so far. The yield at the moment, 487.23. Typically, this would be a safe haven where money would go when things get tricky, when policy gets volatile. That's not happened this week. In fact, some investors have been unnerved by what's been happening down in Washington, D.C. To turn to foreign exchange just briefly, this is what things look like at the moment. Euro dollar at the moment, 113.56. The euro positive on the week. The dollar, DXY, is down about 3% on the week so far. We're heading towards a pretty ugly week for both bonds and the US dollar. With some economic data, let's cross over to Mike McKee for more to get you some PPI. Good morning, Mike.
Well, we're going to start with a big surprise again this morning on inflation that the Fed should be touting. The PPI for final demand headline number falls 0.4 after last month a 0.1 gain, which is revised upward a little bit, but the forecast was for just 0.2, pushes the year over year to 2.7% from 3.2%, a big drop in the annual rate of producer prices at a headline level. And the Bureau of Labor Statistics says a lot of that was gasoline prices. We saw that effect yesterday in CPI. For the core, a 0.1 decline after a 0.1 rise the prior month. We were expecting a 0.3 rise, pushes the core rate to 3.3 from 3.4, and then core ex trade up just a 0.1. 3.4% is your annual rate there. Now, goods prices is the surprise in the PPI, not completely because of gasoline, but final demand for goods moved down 0.9, the largest decrease since October of 2023. 3/4 of that, they say, is because of final demand energy. Food went down 2.1% during the month. The indexes for chicken, eggs, beef, veal, fresh dry vegetables, and diesel fuel moved lower. So we'll have to check on the eggs prices. But services fell 0.2%. So both services and goods were down. There was some thought that we might see some tariff bleed through into this report, which, of course, put together before the tariff announcements, but doesn't look like there's much in there right now.
Mike McKee, thank you, sir, on the latest. We'll return to Mike for some details in about 5 minutes' time. Joining us around the table, Veronica Clark of Citi. Veronica, good morning. Good to see you.
Good morning.
We're not really moving on these headlines. These should be comforting words for the Federal Reserve. They should be getting ready to reduce interest rates. You think they will cut rates as soon as May?
Yeah, we do. I mean, I think there is the sense that maybe this March data is still a bit stale. We haven't seen the tariff pass through yet, and I fully expect that we will see higher consumer goods prices as we're getting into the summer. But some of the details of the inflation data we got yesterday, we'll see what the details are of PPI. We saw particularly weak services, the largest decline in non-shelter services since May of 2020. And that weakness, it was in volatile components, but it was in airfares and hotels and car rentals. It feels like softer demand kind of weakness.
I remember reading a note after Wednesday's CPI, and it was what could have been. There was this feeling that the disinflation that we're seeing in this data could have been what we were hanging our hat on with respect to what the Federal Reserve was going to do. How much does the move in the long end of the yield curve really challenge their ability to respond to potential weakness by cutting rates? Yeah,
I mean, obviously, cutting rates is going to not necessarily impact that 10-year yield. It will impact the short end of the yield curve. I think, as we start to see weaker demand data, and I think we will, weaker labor market data, that is what they're going to be reacting to, and they still will be cutting. But all of these, market functioning concerns, there are other things they can do. Buying assets again. I don't know if anyone's thinking about that quite yet. Guidance we've heard from Fed officials doesn't seem too concerned yet, but that is a possibility.
Well, earlier this week, Mohamed El-Erian said that maybe the Fed could have gotten quite close to having to execute some sort of emergency quantitative easing during some of the turmoil earlier this week. I just wonder if cutting rates is the prescription that this market still needs, given the fact that the long end might even sell off more in the face of rate cuts.
Yeah, it's possible. But I think the market does want to know that there is some put from policymakers, and the Fed is part of that, that the Fed will be there to support activity. Obviously, they're going to have to balance the employment and inflation sides of their mandate. But I do think ultimately the Fed is going to lean on that employment mandate more.
You said that you're expecting to see the increase in consumer goods with tariffs. When do you actually start to see that drip in, especially since the administration is talking about negotiations?
Yeah, I mean, it is really hard. Usually these pass-throughs maybe happen a couple months after the tariffs take effect. So yeah, it's not in this March data yet, but as we're getting into May, June, maybe that's when you start to see it. But there is, the uncertainty question does mean maybe you pause everything. You're not investing, you're not hiring, but maybe you're not changing your prices yet. You don't want to raise those prices, for a consumer that can't necessarily pay it just to then have to cut them later. That's creates more volatility. So maybe we're holding off a bit longer, but the size of these tariffs that you probably will see higher consumer prices.
Had some bank earnings this morning. The guidance was pretty decent from JP Morgan. In fact, they increased it. The CFO spoke just moments ago. Jeremy Barnum had said the narrative is wait and see. And that's what it feels like for the broader US economy. What's the high frequency data that you're looking at the moment to sort of gauge how this economy is developing?
Yeah, this is very much wait and see, and this is an interesting time for the labor market, I think, to be in this wait and see mode, because this is a time of year when businesses start hiring. This is when you're hiring for the summer. This is when new students are entering the the labor force. So I'm really watching trends in hiring, and the best high frequency data for that, I think, is continuing jobless claims, because that's going to tell you if you did happen to get laid off, how quickly are you coming off of those unemployment benefits. If those start rising, that correlates really well with the unemployment rate.
What's the trend at the moment coming into this?
Yeah, I mean, I think this is a labor market that has been loosening for a while, and it has been driven by that low hiring dynamic, which I think was going to be a problem this time of year anyway. That uncertainty, that pause in activity is going to make that dynamic even worse. So this was, I think, already a labor market that couldn't handle a shock like this.
I just wonder how much the dynamic and the way that we talk about the Fed has to change, given the fact that they cannot respond in the same way if truly treasuries are not the risk haven that they have been in the past.
Yeah.
They are dealing with a very different dynamic. I just wonder, especially if they're dealing with stagflation, especially if they're dealing with companies that are coming off a really resilient place, at what point do you change the parameters of how you even understand what kind of Fed intervention looks like, given some of these uncertainties?
Yeah, I mean, I think their tools are, the toolbox has grown, right? We know that, the last 15 years, but their tools are somewhat limited. Certainly interest rates are a blunt tool. I mean, I think we have to just know what we know about this Fed, and this Fed has been a Fed that has been surprisingly dovish. It's a Fed that cut rates 50 basis points in September. It's a Fed that in 2019, when we did have tariffs, we had manufacturing weakness, and we had some wobbles in the equity market. It's a Fed that cut rates 3 times in 2019.
You and the team haven't been shy about big calls. I remember that very aggressive call in the hiking cycle, and people laughed about it, and then they went even harder than you were expected.
Yeah.
So nothing would surprise me. I think we've said it repeatedly on this programme. After the pandemic, then we've all got to be humble about what could happen here. Veronica Clark of Citi looking for that first interest rate cut on May 7th from the Federal Reserve. Michael McKee's back with us for more. Mike, have you got more details?
Yeah, we got some interesting numbers in here that the Fed will be interested in, and of course people on Wall Street. We didn't have a lot of tariffs in March, but we did have the steel tariffs and steel mill products, and this is in the United States, went up 7.1%. Economists have been warning, American producers are going to raise prices if they can because of the tariffs as well. But some of the numbers that go into the PCE have been pretty good. Portfolio management up only 0.2% after an 8% rise last month, and we saw airline fares drop by 4% during the month. So some good news there. It'll be interesting to see after the smart nerds put their pencils to the paper what they think PCE is going to be. One other one that I wanted to mention was egg prices. Yesterday, we criticized the administration because egg prices had gone up at the consumer price level. At the producer price level, they fell 21.3% last month. So maybe we'll get a tweet on that soon.
Nice. Saw what you did there, Mike. Appreciate it. Mike McKee, thank you very much. Joining us now around the table, Tony Crescenzi of Pimco. Tony, good to see you. It's been a while.
Great to see you.
Thanks for dropping by. I just got one question. Help us answer this. Has Japan been dumping US Treasuries? And how would we know?
In the data, no, slowly. And people talk about China selling, that they'll start selling, but they've been selling since February 2022 when Russia invaded Ukraine. They had at that time 1.15 trillion of US Treasuries. Now they have 750 billion. So almost 400 billion has been sold so far. So this idea that China will sell and have an impact on the market, well, that's kind of looking in the rearview mirror. There could be more of that for sure. And it's all geopolitically driven, but it's not the determinant of yields right now.
So what is the determinant? What's going on right now?
Well, I think the nervousness you see in the value of the US dollar and the concerns in markets reflects this, a big concept. And I'm going to talk about it because I wrote a book on it. It was a decade ago. And Tom Keene, I heard on the radio this morning talking about how the Greek yields, a 30-year bond, is lower than the US 30-year bond.
I'm pleased Tom hasn't changed. Continue.
So what that tells us, John, of course, is that something's different in terms of the assessment of credit. Now, a decade ago when I wrote a book, it was called The Keynesian Endpoint, the idea that nations can reach practical limits to their indebtedness. Greece reached a Keynesian endpoint, could no longer borrow from the financial markets because of its credit problems. The UK, under Liz Truss, 2022, reached a Keynesian endpoint, and ever since, Rachel Reeves, the Chancellor of the Exchequer, the Treasury Secretary, has put the UK in austerity. So the US is seeing stress related to the idea of reaching practical limits to indebtedness, and it needs the world to have confidence in the U.S. to fund the high level of indebtedness that we have. So that's one of the major concepts to be thinking about in terms of the stress in markets.
So are you saying that what we have seen this week is Donald Trump's Liz Truss moment for the United States?
I'd rather call it a read my lips moment. George Bush, 1988 convention speech written by Peggy Noonan, famous for writing speeches from Ronald Reagan. She said the biggest takeaway was when he said, read my lips, no new taxes. 2 years later, as president, he raised taxes because the interest on the debt reached a record level, 3.2%. That stands today. That'll be broken next year. I say it's a read my lips moment because George Bush had to do something that was anathema to the party, make a politically difficult decision to raise taxes. So today, we see, with societal upheaval, stress related to difficult choices that we have to make because of the high level of indebtedness. And so we'll have more of these read my lips moments ahead, stress regarding how much to raise taxes, cut taxes, spending, etc. So lots of difficult decisions that have to be guided and managed very carefully and communicated well so the markets understand where we're headed.
Tony, how do we get from a read my lips moment, though, to a Liz Truss moment?
If there's complete ignorance of what the bond market is concerned about, I would think that you would have that moment. But so far, you see some relenting to the bond market, and the James Carville-like. Remember, he said, of course, he'd like to be reincarnated as a bond investor because he can intimidate anyone. If anyone, if the policymakers decide to say no to the bond market in the sense of allowing inflation to rise, so the Federal Reserve could permit it, could create that moment, but it's not. And that's why you see Fed Chair Powell being very slow and gradual and prudent about rate cuts because it's the right thing to do, because high inflation would be saying something very negative to the bond market. So I think it's if we go on a fiscally irresponsible path, you see the bond market pushing back. And what I would expect then, the final word, is a hall of mirrors effect, where not only are investors looking at policymakers, but policymakers are looking at markets because they matter a great deal now with the high level of debt that the U.S. has.
Aren't we there right now? Policymakers looking at markets? Donald Trump even talked about that the bond market was a bit queasy overnight.
It happened now, but in a multi-dimensional game of chess that you know Donald Trump plays, if you think he's thinking that, then you've got to think something else, perhaps. Who knows? So it may be the case that policymakers are looking. And the big signal this week from policymakers in Washington and Trump's team of rivals is the ascension, if you will, of Scott Bessent, the Treasury Secretary, speaking more in a calm fashion in ways that we're used to, Rubin-esque, you could say, as we saw under Bill Clinton and Robert Rubin as Treasury Secretary.
We were speaking with Greg Peters of PGIM Fixed Income earlier, and he said that this week really has been a game changer for him, that he can't put this back in the bottle. You can't unsay certain things, and that this really is making him rethink the role of treasuries as a safe haven asset, given that if the goal is to reduce trade, then essentially there will be less dollars overseas to invest naturally in U.S. treasuries. Are you thinking about something similar?
Yeah, and I was looking this morning, and anyone could, on the IMF website, the COFER data, COFER data. It shows how much of the world's $12 trillion in reserves is put in the U.S. dollar. The figure's today 58%. It's been in decline. The next closest nation or set of nations is Europe at 20%. For the Chinese currency, there's fewer dollars or reserves in its currency than in the Canadian dollar. And so one other point to make, though, that's just the background. If you lined up friends and foes of the United States, and I don't mean to put anyone in the foes category, but just deemed or perceived as foes, you'd see that the nations that are friends would have still have account for about 60% of world reserve assets. So if each of the friends and foes went to their respective corners, you expect that the amount of money held in dollars would still be roughly the same, close to 6%, if it went to the extremes. That's one major point. The next one is liquidity. Of course, the U.S. bond market this week has seen, according to the New York Fed, a $700 billion or so of daily volume. No market comes close to that. This isn't to say that over time we couldn't see that 58% of money held in dollars decline, and you have a plurality. 49% in dollars, more in euros, more in the yen, et cetera, et cetera. It's possible, and it'll be gradual. I wouldn't expect it to be immediate.
Lisa, I'm pleased you brought up Liz Truss for a bunch of reasons, including this one. The former British Prime Minister eventually left, had to reverse policy, made a scapegoat of her Chancellor. It's a very different moment for this moment in the United States. I don't see that happening anytime soon.
Well, I don't foresee President Trump stepping down. It's unclear who he can scapegoat. This was what he promised. Promises made, promises kept, and there are a lot of people who say ultimately that the goal is the right one. But you raise a great point. What's the off-ramp? How much do you say that what we are seeing right now is a structural change that is going to last, where you cannot get these relationships back in the same kind of way?
Tony, it's good to see you. As always, thanks for dropping by.
Thanks for
Thank you.
me.
Tony Crescenzi there of Pimco. Equity futures right now on the S&P 500 up by 0.5%. With an update on stories elsewhere, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March PPI unexpectedly falling. Gas and energy costs playing a major part in that. It added to the tamer than expected inflation readings that we've been getting leading up to the wave of tariffs. Thursday's CPI report also came in soft, but economists do expect inflation numbers to increase throughout the remainder of the year as President Trump's trade policy takes hold. And we also had a strong start to bank earnings on Wall Street. Morgan Stanley reporting first quarter trading revenue that topped estimates. Morgan Stanley stock traders took in a record haul in the quarter, and it raised its guidance on net interest income. Now, on the other side of things, Wells Fargo missed on net interest income with loan demand remaining soft. Elsewhere, Shein is getting ready to go public. Reuters reporting that the fast fashion retailer secured approval for a planned IPO in London, but is yet to get the sign-off from its Chinese regulator. Shein and the UK's Financial Conduct Authority declined to comment to Reuters, and a representative for the FCA also declined to comment to Bloomberg. And that's your brief, John.
Danny, thank you. Thank you very much. Up next on the programme, we'll set you up for the week ahead, and we'll head down to Washington, D.C. to catch up with Bloomberg's Tyler Kendall. From New York City, this is Bloomberg. The opening bow is about 39 minutes away. Equity futures on the S&P just about positive by 1/3%. With some movers this morning, your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. We got some bank earnings to work through. Most of them positive, save for Wells Fargo, which is down in the pre-market. But JP Morgan is higher, though this is still far off of the highs that we saw this morning. At one point up 2%, so some of that getting pared back, but overall a really strong quarter. Record stock trading revenue from them. Also an upgrade to their net interest income outlook, but again unable to hold on to the most of their gains. We also heard from Morgan Stanley too, a strong quarter from them as well, but again it's the same pattern. Unable to hold on to the gains. They are now down 0.5%, despite the fact they talked about really strong stock trading revenue as well. And again, maybe it's just this era of uncertainty that we're living in that makes it hard to really buy into these players. Now, one stock that is gaining this morning, or at least let's hope it doesn't prove me wrong, it is still gaining up 1 1/3% is BlackRock, which is remarkable because after they reported earnings, first they were down, now they're up. Again, everything is swinging, very volatile this morning. BlackRock missed when it came to their inflows, but analysts saying, look, it was a noisy quarter, but Evercore pointing out the fact it has a really diverse platform, which means that it can weather some of the tariff storm and the resulting turn in sentiment. John.
Danny, thank you. Great work this morning. As always, some of the movers to look for going into the opening bow, going into the weekend and out the other side. This is what we're looking at this morning. 10 a.m. UMich sentiment. 1 p.m. a White House press briefing. Monday, earnings from Goldman. Tuesday, from Bank of America and Citi. Plus, United Airlines results after the closing bell. Wednesday, retail sales. That number will become more and more important. Thursday, an ECB decision, plus another round of jobless claims. Down in Washington, D.C., Bloomberg's Tyler Kendall joins us in the nation's capital for more. Tyler, we've had the retaliation from China. What has the response been down where you are?
Yeah, hey, John, we've gotten some fresh reaction from the White House this morning. Of course, Energy Secretary Chris Wright on this program saying that the tariffs are all just part of the negotiation. But we also heard from USTR Jamieson Greer in another interview calling Beijing's reaction unsurprising but unfortunate. Up to this point, President Trump has really tried to strike a more optimistic tone, particularly when it comes to China, saying that he's going to hang tough, but also that he has great respect for China's President Xi Jinping, but that he is still waiting for his call. We should note that the two leaders have not spoken by phone since President Trump was inaugurated back in January. And of course, as you've been discussing this entire program, Bloomberg Economics talking about how this will all but halt trade between the two countries, as we're seeing U.S. factories canceling orders, recent data showing us that trans-Pacific ship orders are already declining significantly as we start to see the impacts coming through. And John, I would just point you quickly to the countries that this administration are talking about. We keep hearing Japan, South Korea, Vietnam, India, of course, all countries that are geographically close to China.
Tyler Kendall, the latest. Some real tension here. Negotiations in some places, retaliation in others. The latest from Tyler down in Washington, D.C. One more programming note for next week. Keep an eye out for this. Annmarie, an exclusive conversation with the Treasury Secretary, Scott Bessent, live from Argentina early next week.
So obviously we'll be talking about trade, whether that's the negotiations that he's involved in, and also when it comes to China. Is this really the start of a negotiation, as Secretary Wright said? But also, what's going on in Argentina? Argentina just renewed this currency swap line with China. There are reports potentially there could be an extension of credit from the U.S. We do know that Argentina's Milei has a very close relationship with Donald Trump. But Latin America has become this battleground for influence between Beijing and Washington. And that's what I think makes Bessent's trip to Argentina so important at this moment.
Are you hopeful we get a quiet weekend ahead of that?
I don't think that it's possible. Sure, I'll be really hopeful, but I've got a feeling that there are plenty of fireworks. And if nothing else, if there are no fireworks, that alone will be news.
This week has been exhausting, hasn't it? It really has. The volatility has been off the charts, reminiscent of things we saw in COVID back in the great financial crisis. I'm sure you've all seen it all a million times over, but this felt different, a structural shift and perhaps the erosion of safe haven status right here in the United States. That debate will continue through the weekend. Coming up on Sunday night at 6 p.m, we'll have that conversation, a surveillance special, just giving you a jump start on the trading week as US futures trading gets underway. That will begin at 6 p.m. Eastern time on Sunday. Look out for that. Special coverage with Bob Michael at JP Morgan, Libby Cantrell at Pimco, and we'll be catching up with Stuart Kaiser of Citi. From New York City, that does it for all of us. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.